So let's have a look on question number 25 now. Based on the following data, acha, what exactly we have to calculate in this question is the net asset value. Keep that in mind. And the net asset value is nothing but a simple concept. Total assets minus total liabilities at market value, both of them, divided by the number of units. That's it. But the major part or the difficulties that you will face is to bring everything to the current market value. Have a look. Based on the following data, estimate the net asset value on per unit basis of a regular income scheme of mutual fund on 31st March 2015. Now the listed equity shares are at cost and ex dividend. We also want ex dividend itself. So it is 40 lakhs. Cash in hand as on 1/4/2014. That means this is opening. This is the opening 1/4/2014. This is March 2015. We have to calculate the NAV after 1 year. So this is the opening cash balance, means if there is any kind of cash expenses or income, it will be adjusted to that 5 lakh rupees. Bonds and debentures are at cost of these bonds and debenture. Understand? Out of this 8.96, 2.50 are not listed and not quoted. It means we can bifurcate these bonds into two parts, listed and unlisted. And out of this, 2.50 are unlisted. That means listed bonds and debentures are 6.46. Okay. Other fixed interest securities are at cost right now, 9.75. These are the fixed interest securities. Securities which pays fixed interest. Dividend accrued assets. It is accrued. It is not a liability. It is an asset which we have to receive. Amount payable on shares. Liability, payable. Whatever might be the reason. Expenditure accrued. It's an expenditure. It's a liability. Okay. So these three are the assets and liabilities which will be added and deducted. Current realizable value of fixed income securities. Find out the fixed income securities. Of face value of 100 is 96.50. So these are at cost. That means these might be at 100 rupees. And the value of those fixed interest securities has been reduced to 96.5. Now what exactly you have to do is, you have to prepare the same statement. Okay, let's read it one by one. The number of units are 2,75,000. Listed equity shares were purchased at a time when the market portfolio was 12,500. Understand the concept of beta. Now this value of shares is linked to the market. And we purchased 40 lakhs of share when the market was 12,500. And now if the market is 19,975, can we calculate the current market value of the equity share? Yes, sir. If we are going to consider the beta as 1, the change in the market will be the exact change in the equity share to bring the value, current market value. There has been diminution of 15% in unlisted bond. See, this is unlisted bond and it will be reduced by 15%. Again, there has been diminution of 15% in unlisted bonds and debenture. Listed bonds and debentures carry a market value of 7.5 lakhs. So forget about 6.46. Now the total market value of this is 7.5 lakhs. Okay, sir. On NAV date, operating expenses paid means cash. It will affect the cash balance. During the year are 2.24 lakhs. So you will just deduct 2.24 out of this. Am I right? Okay. What else is given? Nothing. So take every item from the table one by one as it is given and give the current market related changes to every item. So the 40 lakhs of value will be worth this much. How much? 40 divided by 12,500 was the market. Now the market is 19,975. So the current market value will be 63.92. So you will take 63.92. The cash balance will be 5 minus 2.24. Is there anything which will reduce or increase the cash balance? No, sir. There is no other expenses or cash income or expenses which has to be adjusted in the cash balance. See, if in this question they would not have given this, that the cash balance is the opening cash balance, then we would have assumed it as the closing cash balance. And not giving this bracket related data would have changed the treatment of 2.24, that we are deducting now because it is the opening cash balance. But if you assume it as a closing cash balance, then you are not going to deduct anything out of this balance, and we will assume that everything which has to be deducted has already been deducted, and that's why that's when the 5 lakh has been arrived. So we will not deduct 2.24 if this is a closing balance. Okay. Then bonds and debenture, out of this 8.96, listed bond will be 7.5 and unlisted bond will be 2.5 less 15%, that's 2.125. Cool. I will just ignore this because it is already considered in the above part. Fixed interest securities. See, 9.75 lakhs is the total value at 100 rupees of the cost. But those fixed interest securities are just at 96.50 rupees now. So the value has reduced. How much? From 9.75 to 96 from 100 to 96.50. So the current value of this will be 9.40875. Okay. Dividend accrued, we will add it in the investment. All these are a part of the investment. This is investment, the total of investment, add the asset, deduct liability, and you will get the net assets. Apart from this, there is no other thing which has to be added separately or deducted. So have a look. Equity share 63.92. What exactly we have calculated is 63.92 here. Okay. Can you see? Equity share 63.92, that is nothing but 40 divided by, what was the calculation? 12,500 multiplied by 19,975. Cash in hand 5 minus 2.224, that's 2.76. Bonds and debenture not listed, that means 2.5 less 15%. That's what they said, that the unlisted bonds and debenture has diminished in the value by 15%. Listed bond and debenture, the direct value is given. Dividends accrued, you are going to add it. Fixed interest securities at a current market value 9.409, which will be written like this. What was the total? 9.75. So you will make it like this, 9.75 divided by 100 into 96.50. So this is your total assets. Now out of this, the two types of liabilities will be deducted. The total liabilities, net assets will be assets minus liabilities. This is going to be the net assets divided by the number of units, which was already 2,75,000, and the net asset value will be here. That's very easiest question. Now the question is the easiest one, but giving a treatment to each and every part and not making a mistake is the difficult task. It's not that easy. It's very easy when you see the correct answer itself, na? And I'm explaining, I'm not writing one by one. You do it on a blank paper and then you will realize that what is the level of difficulty of this question and how you can make mistakes. Okay. Now, question number 26 is your homework, but I will just give you certain figures. See, there is no bracket given here in front of cash in hand. That means, can we assume this as a closing balance? Yes, sir. So if we assume this as a closing balance at 1.23, and if there is something called as expenses given in the question, let's just find out whether there is any expenses. The listed shares, present index, value of the listed bonds. No extra expenses I think is given in this question. Otherwise, we would have taken it. No, sir, we would not have taken it. 1.23 is written as it is. I want to say one thing, that even if some expenses would have been given here, we would not have given a treatment for that. We would have ignored it because we are assuming that this is a closing balance in such a case, and 1.23 is arrived after all the adjustment which has to be made. Okay. So these two are clear. Then bonds and debentures are at cost. So these two are divided again into listed and unlisted. Unlisted are 1 lakh, listed are 3.3 lakhs. And one more thing, the controversial thing which is going on from years in such type of question is that other fixed interest securities are at cost 4.5. If you read the same statement, it is exactly same. Other fixed interest securities are at cost 9.75. What we did in the previous question was we brought 9.75 to the current realizable value, which is 96.50. Right? But in this question, we are not doing it. We are keeping this 4.5 as it is. See. And you will see the treatment. See. This. Current realizable value of the fixed interest securities is 106.5. In the previous question, it was a diminution in the value. In this question, there is an increment in the fixed income securities, and still we are ignoring it. Why? Why are we ignoring it? There is no proper reason for to the with the institute for this, but the only thing that they are doing is, if such a statement is written in your question, other fixed interest securities are at cost, that means you have to keep it at cost. That's what they want to say. Keep other fixed interest securities are at cost. This statement was missing in the previous question. This is the same. Other fixed interest securities at cost. In the table, it is same. Other fixed interest securities are at cost. But there was no such statement at the end of the question that we have to keep the other fixed interest securities at cost. In this question, the statement is given, and that's the major reason why the institute has not changed this other fixed interest securities at cost in the answer. They have kept it at cost itself. They have not taken it to the realizable value. That's the major change. So on a summary, I can say one thing: if such type of question comes in the exam, the only thing that you need to make sure is that whether there is any kind of a statement like this, because this has happened 3 to 4 times. If the statement is given, there are only 2 questions in the compiler because I removed all the repeated types of questions, right? These 2 are kept just for the explanation. So please understand, whenever the institute in RTP, MTP or exam paper asked such type of question and given such type of statement, they didn't change the fixed interest securities. They kept it at cost. But whenever such statement is not given, they change it to the current realizable value, as we did in the previous question. So you need to make sure. Write down in your compiler itself. Don't do not fixed income securities at current realizable value if this statement is given in question. So that's the only trick. Otherwise, the treatment is wrong according to me. We should have taken it at current realizable value. That's the concept. Let's forget about it. We cannot help it now. Dividend accrued, you will add it. Amount payable on share deducted. Expenditure accrued, you will deduct it. Other things are same. Number of units 20 lakhs. One of the mistakes that you can do here is you will divide all the assets by 20 lakhs. No sir, because the figures are given to you are here in crores. So if 500 crore is the net assets and you divide it by 20, that means 20 crore units. But you don't have 20 crore units. You have 0.20 crore or 20 lakhs. So they have done it purposely. Most of the student till the end of the question answer will be right, and they will just make a blunder by writing such equation 500 by 220. They did not realize that this was in crore and this was in lakhs. and you made a blunder, the entire answer will be wrong. So make sure that you write instead 0.20 crore. Both the numerator and the denominator should have the same basis. So 0.20 crores. That's very important to write down here. Whenever you will revise this question, you will remember that, okay, we have to change it into the lakhs. Okay. You will give a treatment for the listed shares, value of the listed bonds, rest everything is same. So the net assets are 54.26 crores divided by 0.20 crores and you will get 271.30. Don't get confused with the crores and lakhs, right? Okay, so this was question number 26. It is very much similar to question number 25. There were only couple of things that you need to needed to make sure. I will just mark it, that what was the difference from the first question to the second question. This is the first difference where the opening dates are not given. So we will assume it as a closing balance and we will not give any treatment to the expenses or cash balance or the cash payments. Okay, assumed closing balance. Okay, the second treatment is this at cost. You will keep it at cost if the last statement is given to you. So you should avoid making mistake here, here and here. Numerator and denominator should have same basis. Okay, let's move on to the next question now. Question number 27, have a look. The following particulars related to Vishnu fund schemes is given to you. And investment in share are at cost: pharmaceutical company, construction industry, service sector company. Please focus on this. This is very good question. And the values are given to you in crores. Okay. So they have made an investment in 5 different types of companies. Okay. And that's in equity shares. So pharmaceutical, construction, service sector, then IT companies and real estate. This much is the investment in shares. Now the investment in bonds, fixed income. Listed bonds, 8,000, 14% bonds of 15,000 rupees each, and unlisted bond. Okay. Now the number of units outstanding also given in the same basis, that is crores. Expenses payable will be the liability. Cash and cash equivalent will be the liability, so it will be deducted. Cash and cash equivalent is the asset, it will be added. Market expectation on listed bond. So they're talking about this. This will be yield. Now this is the only thing, I think, this is the only thing in the entire question which will give you some kind of a headache. Okay, let's move ahead. Particulars relating to each sector are as follows. And now all the sectors are compared with the index. The index when you purchased those securities and the index on the valuation date. So basically you have to consider the beta as 1 for all the securities. Calculate the percentage change in the index and apply the same on the pharmaceutical, construction, service sector, IT sector and real estate industry to bring the values of these investment at the current value. So that's the only reason this entire table is given, that you have to consider the change in the index as the change in these shares. Okay. After that, the fund has incurred the following expenses. Okay. Consultancy and management fees, office expenses and advertisement expenses. 480 plus 150 plus 38. So the total expenses are 668 lakhs. And trust me, I think we don't have to deduct this from the cash and cash equivalent. 668 lakhs, I don't know, but let's see. 668 lakhs means 6.68 crores. Right? Now, calculate the net asset value of the fund. Total assets minus liabilities. Net asset value per unit. You just have to divide it by number of units and you will get the second answer as well. Let's first find out this one. And this is the easiest part. Okay. What are you going to do? First of all, pharmaceutical company, 79 crore is the current value, and 79 crore divided by 260 was the index at the time of purchase, multiplied by 465 will give you the current market value of the pharmaceutical company. And you are going to do it for all the others, 31 and 56. See, 31 divided by 210, 56 divided by 275, multiplied by the current value of the index, and you will get the current value of the shares. After that, 34 and 10. 34 divided by this, 10 divided by this, multiply, equal to. You will get the current market value of all the shares. Cool. Let's focus on now investment in bond. Listed bonds. First of all, listed bonds, 8,000 bonds, 14%. This is called as the coupon rate applied on the face value, 15,000. This is the face value. Okay. And the market value is 12%. And this is the yield. Market expectation on the listed bond is 8.842%. How to calculate the current market value of the bond? Sir, it's very simple. Market value is equal to, focus on this thing. Can I say one thing? In the bond valuation chapter, you have learned this part. And that's what you have to apply here. Current yield is equal to interest divided by market value. Market price. Okay. Then, can I say market value is equal to interest divided by current yield? True. The formula has been shifted. Interest is nothing but 14% on 15,000 and the current yield is 0.08842. And you will get some figures. 15,000 into 14%, that's 2,100 capitalized at 8842. That will give you 23,750.28. Okay. And this is all for per bond. Multiply it with 8,000 and this will be 19 crore. So this entire 12 crore will become 19 crore. This is how you have to bring the listed bonds to the market price. I will just write down the proper method of that in the compiler itself. See, I am doing the working for listed bonds. Let's revise it. In the security valuation chapter, you learned about, and that too in the bond valuation concept, you learned about the current yield, isn't it? It was called as current yield, which was nothing but interest divided by market price. Okay. The current yield is 0.08842. Interest is calculated with the coupon rate of 14% at face value of 15,000 to give you the market price, right? So let's do the calculation. Can I write it like this? 0.0 on this side, market price is equal to 2,100 divided by 0.08842, and that's equal to how much? 23,750.28. This is market price into 8,000 number of bonds, and this will give you 19 crore market value. And that's what you wanted, to calculate the market value of listed bond. So you will keep 19 crore instead of this. Unlisted bond, there is no other information for the unlisted bond. Keep it as it is. Okay. So this will give you the total assets. Add cash and cash equivalent in that. Deduct the expenses payable. Don't give any treatment for these expenses because we are assuming this as the closing balance. That means if these expenses are done in the year, for the entire year, these expenses are already deducted from the cash and cash equivalent, and after that 1.5 has been arrived. So we are assuming it like this. If we assume that as an opening cash and cash equivalent, Then obviously you will have to deduct all these expenses, which comes to 6.68 crore. Right now you also know that we cannot deduct 6.68 crore from the 1.5 crore. Okay, let's come to the main criteria now. You have converted all the shares to the current market value. Okay, then you have converted the listed bond also to the current market value. And I think there is some calculation changes. 14 divided by 8.842 multiplied by 12, 19, right? What is 12? 12, 12. Is the current value, na? 12 crore is the current value. Okay, I would suggest you to go with this format. Go with this format. This is a logical format to calculate the 19 crore, because now what they have done is they have taken 14 as a percentage, as a rupees, multiplied it by 12, which is a bad thing, and then 8.842 in the denominator. Forget about that. Follow the method that I have taught you. Please, this might be sounding a shortcut to you, but if you follow the previous one, you will not face any difficulty if any question comes in the exam like this. Then unlisted bonds we have kept as it is. You can see cash and cash equivalent has been kept as it is. I will write down because it's a closing balance. That means all the expenses were already deducted. Less expenses payable, whatever it is. This is the net asset value of the fund. This is the answer to the first part. You take this and divide it by the number of units. You will get the answer to the second part. Number of units are 4.20 crores. Are these given in this question? Yes, sir. Number of units outstanding is given in the question directly. So 4.2. So first two answers are were pretty easy to calculate, net asset value of the fund and the per unit. Now, if the period of consideration is 2 years and the fund has distributed 3 rupees per unit per year as cash dividend, ascertain the net return. Net return to the investor, obviously. So 3 rupees per unit. Okay, sir. 3 rupees per unit is the period of consideration. That means NAV 0 and NAV 1 has a difference of 2 years. How to calculate the net return now? Annualized return, per annum return. For the investor, you can clearly see that the 3 rupees is the income and the capital appreciation will also be the income. But for the capital appreciation, we need NAV1 and NAV0. We have NAV1, which is 98.97, right? 98.97. But we don't have NAV0. So the question is, can we calculate NAV0? Yes, sir, we can do that. So have a look. Question number 27. See, they said the period of consideration in this equation, in this particular question, is this. Okay. They declared 3 rupees dividend here, 3 rupees dividend here. Am I right? They said the same thing, that the dividend distributed is 3 rupees per unit per year. And the period of consideration is 2 years. That means NAV1, which we calculated, which comes to 98.97, is at this stage. Now, if we want to calculate the return, we need NAV0. That means this figure. And it's very easy to calculate. Just find out the net assets at this point and divide it by the number of units. The concept will not change, sir. The timing is changing, but the concept will not. And we already know the number of unit is 4.20 crores. The only thing is the net assets. And what do you think? Out of the given data, which particulars should be included at the start of the year in the net assets? So can we say that we have started the investment 27, right? These investments in shares are given at cost. That means these would have been invested at the start of the year. So this all will be included. 79 plus 31 plus 56 investment in shares plus 34 plus 10. So can I say the net assets will include investment in shares plus investment in bonds. Let's see. This also will be included investment in bonds, which comes to 19 crore. 12 plus 7, 12 plus 7, 19 at the time of the start of the year. After that, do you think expenses payable should be considered in the net assets at the beginning? No, sir. This expenses payable gets generated over a period of 2 years. So at the opening, this will be zero. Cash equivalent, we don't know the cash and cash equivalent detail. We will still assume it as zero. Because if we are assuming cash and cash equivalent already as a closing balance, we cannot assume it as an opening balance, and we don't have to calculate the opening balance also. If you might be thinking that we can calculate the opening balance by adding the expenses paid, like this 480 lakhs, 115, 38 lakhs in 1.50, this will again go wrong. Okay, there might be some other things as well, market expectations. So that's it. This is the only thing that you should include in the opening net assets. So investment in shares comes to 210 crore, investment in bond comes to 19 crore, divided by 4.20, you will get NAV 0. That's what you have to assume. So 229 divided by 4.20 comes to 54.52. The only controversy that you can do here is you can say we can add opening cash balance as well, which might come to 1.5 crore, the closing balance, plus the expenses paid during the year, because of these expenses the closing balance got reduced na cash balance ka. So we can add the 6.68 before this expenses to the cash balances, and then we can say that the cash balance is also 1.5 plus 6.68. To this extent you can assume it as the part of the net assets at the beginning, but institute has not done it. And I also think that the information related to the cash balance is not that clear, so we can avoid that. See the answers. 210 for the investment in shares, for the bonds 19 crore. The total is 229 crore divided by 4.20. So the cost per unit, which becomes the NAV at the starting, we can say is 54.52. Okay. So if this is 54.52, let's have a look. If this is 54.52, then can we calculate the return? Yes, sir. Very easy to calculate the return now. It's very simple. 98.97 minus 54.52 is the capital appreciation for 2 years. Plus 6 rupees is also the income for 2 years, divided by 54.52. Because that was the investment and we are calculating the return. So the total return comes to 92.53% for 2 years, and divided by 2, it comes to 46.26% or 27% for per annum. Let's just find out the answer in the institute's module. 46.27, right? This is going to be the per unit capital gain, this is going to be the per unit dividend, but these two are for the 2 years. So 50.45 the return, 54.52 the investment. For 2 years you have converted into single year. That's the answer. Okay. And come over to this part. Ascertain the expense ratio. Expense ratio is very simple, sir. Expense ratio is a part of the NAV. So it is always calculated when we take the NAV as basis. So if we are calculating the expenses ratio, that means these expenses have been incurred over a period of this 2 year or 1 year, whatever it is. So the NAV that we are going to take in the denominator will be the closing NAV. Opening NAV does not matter, because at the time of opening NAV, these expenses were zero. These closing expenses are there when the NAV is there. NAV1 is there. So add all the expenses, that is 668 lakh. Okay, just understand what is going to be the formula, expense ratio. So you can take total expenses divided by net assets, or you can do one more thing. You can take total expenses divided by number of unit, that means per unit expenses divided by number of unit, that means per unit NAV. So we can take it like this also, per unit expenses and then net asset value per unit. The answer from both will be same. So we can solve it both ways. Let's do that. You can take the total expenses as well, which comes to 6.68 crore. And if you take the total expenses in the numerator, you will have to take the total assets, net assets in the denominator, which comes to 415.665, right? 415.665. And the answer comes to 1.61%. Okay, otherwise also you can take it 6.68 on per unit basis, and that per unit calculation is arrived at by dividing the total number of units, 4.20. Now the expenses in the numerator are on a per unit basis, so the denominator should also be on a per unit basis, which is 98.97. So this is going to be the same answer, 4.20 divided by 98.97 into 100, 1.607 or 61%. So this is the expense ratio. It's very simple. Keep the expenses in the numerator and the assets in the denominator, and make sure that the basis is same. If the expenses are total, the assets should be total. If the expenses are on per unit basis, the asset should also be on a per unit basis. See this calculation. They have done the total of all the expenses, divided it by 420, that lakhs, that means 4.20 crore. So converted this entire item into expense per unit, and they have taken NAV, net asset value per unit, and the answer is 1.607% or 1.61%. This is the expense ratio, which is quite high, practically speaking. Anything under 1% will be a good expense ratio from the angle of the investors. But right now you can see around 2%, 1.6, 1.5 to 2% is the average expense ratios of the mutual fund. That means they are keeping a lot of money out of your funds. Okay, so this is how the question has to be solved. This is going to be the homework. Question number 28. There is one printing mistake that you need to clear. Instead of this 15,000, you just have to make it 30,000. That's it. This is a printing mistake which you have to do the correction with. 30,000. Make it 30,000. Rest everything is similar to question number 27, and this question was asked in RTP of May 21 exam. Okay. So with this question we end our calculation till question number 28. Question number 29 is going to be a good question, because you will have to apply some methods of security valuation in that. You can see the last column is given of the duration of bond, and that is where the part of this question will be interesting. So we'll take a break, and after that we are going to come back and have a look on question number 29. See you. Okay, so let's come to the question number 29. This is an amazing question where we will be calculating the net asset value itself. So the ultimate purpose will be the same thing, but there will be a different approach towards the calculation of net asset value. So have a look on this question. Based on the following data, estimate the net asset value on 1st July 2016 on per unit basis of a debt fund. Debt fund means safe securities, that is the fund which has invested your money in safe investments, or we can say bonds. So name of the securities are like this: 10.71% Government of India 2028 bond, 10% Government of India 2023, 9.5%, 8.5%, and so on. How many are there? Only 4. Okay. And this percentage which is given in front of the name of the security is called as the coupon rate, which is applicable on the face value. Face value is 100 rupees for all. After that, the next column is the purchase price at which you have purchased every bond of every type. Okay. Then the maturity date, you can clearly see This is being maturing after 12 years, I think, from July to March. So on an average, March 23, December 21, and June 25. Okay, after that, the number of securities that you have purchased, 1 lakh, 50,000, 40,000, and 20,000. Second last is the coupon date. We can clearly see that the first and the last bond that we have purchased is paying annual coupon, whereas the second and the third is paying half yearly coupons. Okay. Then duration of the bond, and this is where the interesting part is. This is the Macaulay's duration which is given to you. Duration of the bond, and what will be the purpose of this, we will get to know about it in a minute. Now these are all the information related to the investment that the mutual fund has made. After that, the number of units of the mutual fund is 1 lakh, which has been issued to the unit holders. All the securities were purchased at a time when the applicable YTM was 10%. The yield at the time of purchase of the bonds was 10%. But on the NAV date, the required yield is increased by 75 basis point. That means it is now 10.75%. What does that mean? It means that YTM has increased. It also means that the market price has decreased. Do you remember the security valuation? In that there was a relationship between YTM and market price, and we used to say that there is an inverse relationship between both of them, and if the YTM is increasing, the market price of the bond will go down. YTM is increasing means higher return. Higher return is only possible when the bonds are available at a much lower price. Okay. What is the use of that? The use of that is this. According to this new YTM, we will have to calculate the new market price, and according to the new market price, we will be able to know the current value of the entire investment that we have made. Because for the calculation of net assets, we need the current value of all these bonds, and the current value will be calculated using duration. Using duration, we are going to calculate volatility, and the concept of volatility will be applied on the 70.75% increase in YTM. Volatility itself says that if the YTM is increasing by 1%, the market price is decreasing by the percentage of volatility. If the market price is if the YTM is increasing by 0.75%, the market price will decrease by 0.75 into volatility. Do you get that concept? This is going to help us to calculate the change in the market price. We can easily calculate the current market value of the bond. Current means the purchase price of the bond, that is 104.78 into 1 lakh. Right? This multiplied by this multiplied by this. Or else we can multiply the number of securities at the end. We can just calculate the current value of the purchase price itself. Okay, so we are going to go step by step. I will just explain everything to you. On the NAV date, the required yield is increased by 75 basis point. Cash in hand and accrued expenses are this much. So we'll use that. Don't worry. So have a look on this question. Question 29. What exactly we have to calculate? Forget about everything. NAV. NAV is nothing but net assets divided by number of units. The number of units of the mutual funds are same throughout, right? So let's just write that, which is 1 lakh. Am I right? 1 lakh. And now we only need net assets. Okay, so let's calculate net assets. Net assets is equal to total assets minus total liabilities. And let me tell you one thing. In total assets, there will be three or two things. Let me just find out. Yeah. Cash in hand. There will be three things. And total liability, there is only one thing. So what are those things? This is the most important part, because if you miss out on any particular thing, the entire calculation will go wrong. So the first is the market value of investment. This is going to take time. Then the second part is the cash in hand, which is directly given in the question. And the third and the most important part is which you don't know and which is not given, which is a secret in this question. See, I will tell you. Focus on this part. You have to calculate the net asset value as of 1st July 2016, right? Okay. Now, if you can see this particular bond, first bond, the next interest payment for the first bond is the 31st March 2017. Am I right? Because it is paying on every 31st March. So the last 31st March was 31st March 2016 when this bond paid the interest, and now it is going to pay on 31st March 2017, and we are standing at 1st of July 2016. So March, April, May, June, 3 months. 3 months interest is accrued in this case. Not due. It becomes due on 31st March 2017. We are standing on the 1st of July, and the last interest was paid 3 months back by this particular bond. That means for the last 3 months the interest has been accrued, which has to be considered in the asset side. First of all, let's focus on this part. 10% Government of India 2023. You can clearly see in this case also the last interest was paid on 31st March. From that point to this point, 3 months has elapsed and the 3 months interest has been accrued. Again, come to this point. For third bond, you can see the last interest was paid on 30th June. Today it's 1st of July. That means yesterday itself the interest was paid. So there is no accrued interest in this case because the yesterday itself the interest was paid. In this case also interest was paid on 30th June. That means no interest is accrued in this case. So interest accrued will be the third item in your asset side which you will consider for the first two bonds only, because that's the only applicable one, right? So we are going to calculate that one also, and the total liabilities is also given to you, which is expenses, accrued expenses. So these are the things which is very important. That is, now one by one you can start the calculation. The two out of these are directly given to you. The rest of the two has to be calculated. Let's start with the easiest one, and we should calculate this one first and then market value of the investment. So I'm making a working note. Let's prepare a working note and the name will be interest accrued. Okay. It has already been given, no? Let's do the working in the compiler itself. I think that's enough instead of writing the entire answer and wasting the time, right? Because we are already short of time. So you can calculate that easily. It's very simple. For the 3 months you have to calculate in both the bonds. 10.71%. First of all, you will apply on 100 rupees. So that becomes 10.71 rupees per bond for the entire year. Okay. It's very simple. Coupon rate multiplied by face value multiplied by 3 by 12. Am I right? And then multiplied by the numbers, total numbers. Number of securities 1,50,000. That's what the calculation will be. See, face value multiplied by numbers multiplied by coupon rate multiplied by 3 by 12. So this is the total accrued interest of 1 lakh bonds. Okay, this is the accrued interest for 50,000 bonds. So practically speaking, 2.6775 rupees per bond is the accrued interest in this. And in this case I think 2.5 rupees per bond is the accrued interest. So this is all the calculation. This will come under your interest accrued asset side, 392,750. So this is going to be 392,750 two more figures which is given. Let me write down 670 to 800 cash balance and 237 400 accrued expenses which will be deducted. Now the only thing that we have to calculate is the market value of investment. I am going to do a certain working here, simple explanation to the part. We have to calculate the current market value, right? Current market value is nothing but we can say purchase price, the price at which we have purchased, plus or minus. We will write down plus. If the sign is minus in the change, it will automatically be changed. Purchase price plus change in the market price. How much the market price has changed. Now, how to calculate this change in the market price? Because this is given in the question. Change in the market price can be calculated by only this thing, volatility multiplied by 0.75%. Why? Because this much is the change in the YTM. Do you remember the concept of convexity? It was like this. Minus Macaulay's, we can say modified duration or you can say modified volatility. So let's simply write down volatility itself. Volatility multiplied by change in YTM. This change in YTM is also given to us. That is 0.75. Am I right? Now comes the question of volatility. How to calculate the volatility? It's nothing but Macaulay's duration divided by 1 plus YTM, the original YTM, divided by N if the coupon payment is half yearly or quarterly or something like this. So at that time you will divide it by the number of times the coupon is paid in a year. So when the coupon is half yearly, the rate will also be half yearly. Okay, so what we have to do for all the four bonds, first we will have to calculate this particular volatility. For all the four bonds, calculate the volatility. Get the Macaulay's duration from the last column, divide it by 1 plus YTM by N. YTM will be 10% and for the half year coupon payment, it will be 2 here. So 1.10 and 1.05 will be the, see, I will tell you. There are four types of bonds, right? Macaulay's duration, let me just write down the Macaulay's duration. 7.3494, 5.086, 4.3949, 6.5205. These are the four Macaulay's duration. Divide these by the YTM. 1.10, 1.05, 1.05, 1.10. Simple. Because original YTM was 10%, annual coupon 10%. Half yearly coupon 0.10 divided by 2, half yearly 1.05, 1.05. Both of these are half yearly and this is annually again to 1.10. And you will get the volatility here in the next column. So once you get the volatility, multiply it with the change in YTM, that is 0.75, you will get the change in market price. Impact that. This is going to be the change in market price. This is the change in the price. And you will get the current market value. This current market, instead of that, you will only get the current market price and then multiply it with the number of units. Do it at the end, number of units to get the market value of investment. So this is how you are going to approach. You need the market value of investment. Then what are you going to do? You are simply going to add and deduct to arrive at the net asset value. Put that net asset here and you will get the NAV. So this is the entire sequence. I will just tell you and I will just shift to the question. You have to calculate net asset value. So net assets divided by number of unit will be the answer. Net assets has to be calculated like this. Total assets minus total liability. Liability is only one, which is accrued expenses. Total assets are of three types in this question. Market value of the investment, cash in hand and interest accrued. We have calculated the interest accrued, cash in hand is given, accrued expenses is given. Market value of the investment has to be calculated like this: the number of units multiplied by the current market price. Number of units is already given in the question, so let me just put a tick here. Okay, so we have to calculate the current market price. Current market price is nothing but the purchase price which is given plus or minus what is the change in the market price. Mostly it will be minus. Why minus? Because YTM is increasing, the market price will decrease. Okay, so change in the market price will be deducted from the current the old price, and that will give you current market price. The change in the market price is the only thing that you have to find out now. Change in the market price is nothing but the volatility multiplied by change in YTM. Volatility, change in YTM is already given to you, 0.75%. Volatility is nothing but the Macaulay's duration and 1 plus YTM divided by n. This is also given, this is given, and this is given. You need to keep on extending your entire calculation unless and until you get all the green ticks in a one formula. See, in this particular formula, this was not ticked. So that means we have to calculate that. In this formula, this was not ticked. So we had to calculate that. In this formula, we had this volatility was not ticked. So we had to calculate that. And now we can see that in this formula, everything is ticked. That means we don't have to go further from this. Everything is now given. So this is the last point. Getting it? So that's what is done here. Have a look in the answer. My suggestion to you, focus on the market price and then multiply it with the number of units at the end. But they have done it in full total from the very beginning itself. That's all okay. So purchase amount is already given to you. You have to make changes in this price. So this is the duration. Duration divided by YTM is volatility. Volatility multiplied by the change in YTM is the change in market price. So this is change in market price. Okay. So 5.011 means reduce this particular amount by 5.011%. So this is the change in market price in terms of rupees. This is in terms of percentage. This is in terms of rupees. And this is the current amount. Purchase price. This is A, B. So A minus B. Purchase price. So this is your current amount. That's it. The story is over now. In the next page, you will take this 203 that you have calculated, cash in hand, interest accrued. These are the three items of assets. So this is going to be subtotal of the asset. Then expenses accrued. This is going to be net assets divided by the number of unit, and this is your net asset value. Are you happy with this? The only two calculations was the value of the securities and the interest accrued. Rest of the two parts were already given. But more important than this is to realize that there are only 4 things in the calculation of the net assets. 3 from the assets, 1 from the liabilities. So that is the most important part. And then the second part is the working for all the 4 parts. So you need to know some linking from the start to the end. Only then you will be able to solve the question. Question number 30 is going to be the next question. Have a look on this question. This question was asked in July 21, old syllabus for 4 marks. This is a pretty good question, and this is going to, and this is very easy one also. Let's have a look on this. Messrs. Strong and AMC has floated a dividend bonus plan. So this is a bonus plan. Remember the bonus plan that we have discussed earlier in previous questions? On 1st April 2016 at a certain net asset value. Okay, so Mr. Strong and asset management company has floated this kind of a plan on this date. Okay, and there is some kind of NAV at that date. The fund has a robust growth and has declared a bonus of 1:5 on 30th September 17. So let's write down. Everything is given already in the statement now, paragraph. We will just write it down here. Let's write down the date, NAV and bonus ratio in the simplest form. So this was 1st of the April 2016, I think. Then 30th September 2017. Then the next date given is 30th September 19. And 30th 1st March 21. Okay. Now, this NAV is not given to us, but rest of the NAVs are given to us in the table here. 85, 92 and 100. Okay, then the bonus was declared here at a ratio of 1:5, the first bonus. And the second bonus was on 1:4, 30th September 2019. And You can clearly see from 2016 to 2021 there are 5 years, 6, 17, 18, 19, 20, 21. For the 5 years the average yield is 17.5%. That means for all the 5 years the net return that has been received is 87.5%. So the NAV has grown by this much of the rate. Do you get that? 87.50%. NAV has grown by this much of the rate, or we can say the bonus has been issued in between also as. Okay, now the first question is what happens is you cannot just recalculate the NAV from this one because of the bonus ratio. The moment you issue the bonus, the NAV again gets split into a lower part. So because of these things you cannot recalculate it from 100. So you cannot consider 100 as 187.50%, and you might be thinking that you can shift directly to this. No, that's not possible because of the bonus that has been given. See, let's say for example the NAV is 100 here. The moment you give the bonus, the NAV gets down to a maximum level. Okay. Now what has happened? Let's see. Mr. Optimistic has made an investment of 15 lakhs. He has purchased, he has made units, he has made an investment of 15 lakhs here. So 15 lakhs was purchased at an NAV. This 15 lakhs was given to the mutual fund at this NAV, and there might be some units that Mr. Optimistic might have purchased. Okay. If we get to know about the NAV, we will get to know about the units that he has purchased. But if we get to know about the units also on that date, we will get to know about the NAV. Okay, so that's the ultimate purpose. And before the plan, 15 lakhs in the plan before the declaration of the first bonus and remain invested thereafter. That means the Mr. Optimistic was in the mutual fund, invested in the mutual fund from the start till this date also. That means the earning for the Mr. Optimistic is also equal to this earnings of the mutual fund, which is 87.5%. Now let me just give you some calculation. On 31st March 2021, can I say that the 15 lakhs invested by Mr. Optimistic might have grown by 187.50%? Yes, sir. So 15 lakhs multiplied by 187.50% is nothing but 28 lakh 12,500 on that date. 28 lakh 12,500, and on that date if you divide this amount by 100 rupees of the NAV, you will get to know how many units he had on 31st March 2021. So this is going to be 28,125. Now from this point you can go back with the calculation of every bonus. See how to do that. This 28,125 is the total after adding this 1. So let's say this is x. So x divided by 4 multiplied by 1 and plus x should be equal to 28,125. I will show you. See, this is x divided by 4 multiplied by 1. This is the entire bonus additional units, and add it to the previous opening units, that is x. So you can do such type of calculation, x plus x by 4 into 1. So this should be 28,125. Okay. So the calculation goes like this: 28,125 divided by this 4 multiplied by 1. Divided by 5. This 28,125 is the total of these two, now 4 plus 1, 5, and multiplied by 4 you will get the opening units. 28,125 divided by 5 multiplied by 4. So we had around 22,500 units before this bonus issue. And do the same calculation here. 22,500 was the total of 5 plus 1 bonus. That means 6. So earlier you had only 5 units. So do the calculation, divided by 6 into 5. That means 18,750. So you had 18,750 units there. 15 lakhs divided by 18,750. You invested 15 lakhs and received 18,750. Can you calculate the NAV? Yes, sir. It's 80. Simple calculation. That's what is given here. See. Amount invested by Mr. Optimistic on 1/4/2016. So we have to make certain changes. It should be 15 lakhs. Okay. Gain during 5 years. Why it is written 16 lakhs? There is a printing mistake, and that's why the entire calculation might change. 87.5. 46. 30 divided by 5 into 4 divided by 6 into 5, 20,000. Okay, even if you take 16,000, 16 lakh na, then still the answer will be same. So it's up to you whichever amount you want to take. So let's do some calculation, and let's keep the answer same. We will just change the investment amount to 16 lakhs. So even if we are keeping 16 lakhs, the answer will still be same. So you add 87.5% in 16 lakh, that comes to 14 lakhs. The total is 30 lakhs at the date of 31st March 2021. So the moment you divide it by the NAV, you get 30,000 units. And then from this point onwards, you go back every step. See, I will just change my calculations here. I will show you. The final answer will still be the same. So let's assume that he has invested 16 lakhs. So 16 lakhs into 187.5% comes to 30 lakhs. So we will write down 30 lakhs here. So the number of units that he had on that date is 30,000. What are you going to do? This 30,000 is nothing but the total of 4 units you were holding previously and 1 bonus. So the total is 5 multiplied by 4. 30 by 5 into 4. So this is going to be 24,000. Again the same thing you are going to do. 6 multiplied by 5. This is 20,000. That means you were holding 20,000 units on that date. So 16 lakhs divided by 20,000, again the NAV will be 1880 only. So that was the major purpose how to do that. I think we have seen this type of question, the reverse calculation in the bonus units. Okay, from question number 31, there will be a little change in the method, or we can say the type of the question, but still the purpose here will remain same, which is calculation of NAV. Let me take a break and I will be back with question number 31. And please understand, 31, 32, 33 and 34 are all of them are of a similar nature. So 31, 32 and 33 are little easier than the 34th question. So directly I am jumping to 34, 31, 32, 33. I am keeping it for practice. If you are short of time, you can skip question number 31 and 32. Directly keep 33 and 34 only for the revision purpose. But make sure 34 should be there. 34, question number 34 out of all these 4 should be in the revision list of your day before exam. Okay. So let's have a look on this question. On 1 July 2016, Mr. X invested 50,000 at an initial offer in mutual fund at a face value of 10 each per unit. So the moment was the initial offer. The mutual fund was coming up with its IPO, which is called as new fund offer, NFO. Okay, and at that time the NAV and the face value was same, which is 10 rupees. At that price, Mr. X invested 50,000 rupees. So you get one thing from this statement is the number of unit. 50,000 divided by 10. The number of unit that Mr. X purchased at the start was 5,000 units. Right? Okay. On 31st March 2017, see, whenever two different dates are given in the question, make sure that what is the distance, or we can say what is the time gap between the two dates. This was 1st of July 2016 and this is 31st March 2017. So from July to December it's 6 months and these are 3 months. So after 9 months a dividend was paid at 10%. We will consider this as rate and it will be applicable on the face value. and an annualized yield was 120%. Yield means the income, and that too annualized. Now you see the difference. The magic is that, or the trick is that, the duration of investment for Mr. X is 9 months only, but the yield is calculated on per annum basis in that question. So you have to convert this annualized yield into holding period return, which will be very easy. See, 120% is the return for 12 months. So how much is the return for 9 months? 90%. Clear with that? 50,000 is what you have invested and 90% is the return in 9 months. So can I say that 45,000 will be the return by the end of 31st March 2017, and return includes three things only. 1, 2, 3. First of all, capital appreciation, then dividend, and then capital gain if any. Okay. On 31st March 2018, 20% dividend and capital gain. Now after 1 year, straight away. Okay. Just after 1 year, 20% dividend and capital gain of 0.60 per unit was given. In the previous part, in these 9 months, no capital gain was given. Only you will find capital appreciation and dividend. Dividend of 10% is there in that 45,000 rupees of the return. Okay, great. But after 1 year, there are three things in the return: 20% dividend, capital gain of 0.60 per unit, and annualized yield is not given. Let's see. Mr. X redeemed all his 6271.98 units when his annualized yield was 71.50% over the period of holding. This is the annualized yield, but over a period of holding. Calculate the NAV as on 31st March 17, 31st March 18 and 31st March 19. So we will assume that this redemption happened on 19 because that's when the party, we can say, that's when all the transaction gets over, na? If we have to calculate 31st March 2019 NAV, we have to make sure that the transaction gets over at that time. If it gets over before that date, then we cannot calculate anything at 31st March 2019. Okay, so all in all, this much is the data given to you. Because it is given in the statement or a paragraph format, it will be a little bit difficult for you to understand what is exactly happening. So let's do something. Question number 34, right? Whenever such type of questions are given, make sure that you are creating a timeline. And we can say this is July 2016. After 9 months, this is 31st March 2017. After 1 year, this is 31st March 2018. And after 1 year, this is 31st March 2019. They have asked us the NAV, 3 NAVs, okay, 17, 18 and 19 for 31st March. That's great. So this is the entire story. Now, if I say what is the holding period, we will say that this is 9 months, this is 12 months and this is 12 months. Are you with me? 12 plus 12 plus 9, that's 33 months of the holding period. Okay, and it is clearly written in the question that for the entire 33 months for the over the holding period, the annualized yield is 71.50%. That means 71.50% is an yield from this to this date. Okay, I will just come to that point. But now let's focus on the first 9 months. We have to find out three things: NAV, NAV and NAV. 1, 2, 3, right? And this is going to be NAV 0, which is 10 given in the question. Okay, at this price you invested 50,000 rupees. So the number of units were 5,000. Cool. Now understand. First part. How to calculate the return? The holding period return is very simple, sir. NAV 1 minus NAV 0 will make sure you are calculating capital appreciation. This will make sure you are calculating dividend and capital gain divided by NAV 0. So Can I say the holding period return is 120%? No, sir, absolutely not. Holding period itself means only 9 months in this case. And the annualized yield given is 120%. So this is for 12 months. We need it for holding period. So convert that. So we can say that 120 divided by 100 multiplied by 9 divided by 12. This will make sure we are taking the figures in decimals. Otherwise, what you can do is keep the 100 out of here and multiply it here. We can do it both ways. So let's take it this only. Okay, NAV1 is something that we have to find out, right? NAV0 is 10 plus. Now tell me one thing. How much is the dividend declared? Dividend was paid at 10%. 10% dividend was paid and the face value is 10 rupees. So how much is the dividend paid? 1 rupee, isn't it? So the dividend is 10% of 10. The number of units are same here in this case, and that's why this first part is at least easy. Capital gain is 0 because no information related to that is given to us, and this is 10. Now tell me, can we calculate NAV1? Yes, sir, absolutely we can do that. 0.90 is equal to NAV1 minus 10 plus 1 divided by 10. Am I right? So 10 will come on this side, 9, NAV1 minus 9, and your NAV1 will be 18 rupees. So this is your first answer. Let me just write down here. NAV at this point will be 18 rupees. Getting it? You received the dividend, right? But what happened in this case is, you can clearly see by the end of the 2019, you have redeemed 6271.98 units. That means the dividend and all type of gain that you are receiving meanwhile is reinvested by Mr. X. Otherwise, if you consider it as not reinvested, then he should have sold only 5,000 units by the end of the 31st March 2009. But he sold more than that. And please make sure there is no other information related to additional purchase. So the additional units that is shown in this figure is received by reinvesting the gains. So how much is the total gain received by Mr. X on this date? 10% of 5,000 into face value 50,000. Not the market value, but the face value. 5,000 into 10 face value, 50,000 into 10%. 5,000 rupees he received as a dividend, which is reinvested back on 31st March 2017 at the rate of 18. Now, understand. Additional units received on 31st March 2017 by reinvesting dividend. How much? Sir, it's very simple. 10 multiplied by 10%, 1 rupee, into 5,000 units, 5,000 rupees divided by 18, reinvested. So 277.78 units has been received. Total units now is on 31st March 2017, 5,000 plus 277.78, it will be 5277.78. Now you have 5277.78 units. This is how the number of units are increasing. Now we are done with the first answer, NAV1. Now let's go to the second part. Now what has happened in the second part is 20% dividend and a capital gain of 0.60 is given to Mr. X, and this entire income would have been reinvested by Mr. X. I will tell you why. Because from this point when he is moving forward, he had 5277.78 unit, but when he redeemed everything, he had 6271.98 units. 6271.98 units. You tell me, how many additional units did he receive in between? can I say the additional units that he has received is 994.20? Yes, sir. And when do you think he would have received this much of the units? Whenever the dividend and capital gain is paid, because this additional units 277.78 was received by Mr. X only when the dividend was given. Now, whenever the dividend and capital gain will be given by the mutual fund, it will be reinvested back on that date, and on the same date NAV, on the same date's NAV, Mr. X will receive 994.20 units, which will make his total number of units to 6271.98. Do you get that? So this additional units is be received by Mr. X on 31st March 2008. Okay, I will just do one thing. I will write it in this manner: plus 277.78. This will make the total to 5277. Plus 994.20. This will make the total to 6271.98. So do you get the figure of this? How did we arrive at this point? 6271.98 minus 5277.78. This much is the additional unit that he had received. But for receiving this much of the unit, he has to give all the gains that he has received at this point. So let's first calculate how much exactly he has received on NAV2. Second part. Dividend received on 31st March 2018. How much? 20% dividend on 10 rupees is 2 on the number of units that he was holding on this date. So tell me one thing. How many number of units he was holding before additional units? It's 5277.78. So he would have received dividend on this 5277.78. So this is going to be the total. Dividend is always calculated on 10,555. Dividend is always calculated on the face value. Now capital gain. How much capital gain? 0.60 per unit. So the calculation is very simple. 3167. The total comes to 13722. What is this amount? This is the total earning of Mr. X that he has received on 31st March 2018. How much? 13,722. Now focus on this thing. 13,722. He received this much of the capital gain and dividend on this date, and what he did with that amount, he reinvested back at that date's NAV. Obviously, whenever he is reinvesting, the date's NAV will be important. He reinvested that at this NAV to get 994.20 units. So can you calculate NAV2? Yes, sir. 13,722 divided by 994.20 will give you exactly what was the NAV on that date. NAV on 31st March 2018 is very simple. $994.20. And before that, I think if you revise, you should know about exactly what is happening. So I will just write down income reinvested on that date and additional units received. And it comes to 13.80. This is your second NAV. Let's write down 13.80. It's very low. How come? Let's check the answer if I have made any mistake. No, it's clear. 18 and 13.80, right? Now let's focus on the last part. Now what happened, I will tell you. They clearly said in the last part that the annualized earning was 70 to 71.50% over the period of holding. So the holding period till this date, holding means from the moment you purchased the units. From this date to this date, the holding period comes to 33 months. And when you calculated the yield for 33 months and converted it into 12 months, they have given the figure of 71.50. Please read it once again. Annualized yield is 71.50 over the period of holding. So what exactly they did is they first calculated the 33 months return and then converted back to 12 months and then posted here in the question. So now what is more important is if the return of 71.5% pertains to this period, then whatever happened in between doesn't even matter. What you exactly paid in the beginning and what you received at the end matters the most. In between, whatever happened was the reinvestment. We didn't pay anything from our pocket in between, right? So the only two things that will matter here is NAV 0, N 0 and NAV 3 and N 3. Or we can just do one thing. Let me change the color of this itself. So you get it. NAV 0, N0, 50,000 was the investment on which he received 71.50 per return per year. So what are we exactly going to do? We are going to convert that 71.50 of 12 months return to 33 months return in the same manner we did it here, right? Convert the return, annual return to holding period. In the first part, the holding period was less than 12 months and now the holding period is more than 12 months. So see, your answer will be pretty simple. Holding period return is equal to, understand, NAV 3 multiplied by N3. This is what you received at the end, na? And what you invested at the beginning was NAV 0 multiplied by N0. And the return is always calculated on your investment, which is NAV 0 multiplied by N0. So you understand what is there exactly in the formula. This is the amount that you received at the end. This is the amount that you paid at the beginning. And this is the amount that is called as investment. This should be the holding period return. Now, holding period return. The question has given you annualized return 71.50. So I cannot say that 71.50 should be kept here. It should be converted. 71.50 divided by 100 to make it into decimal, multiplied by 33 divided by 12, because this is 12 months return and the holding period is 33 months. So you will keep 33 in the numerator. Now let's start solving. NAV 3 is our purpose. And we have the units N3, which is 6271.98. 6271.98 minus 50,000 and divided by 50,000. Am I right? So let's do the calculation. Now 1.966. This will be 1.96625 is equal to NAV 3 into 6271.98 minus 50,000 divided by 50,000. Now what exactly you are going to do? Transfer this 50,000 to that side, it will be multiplied with this figure, and then transfer this 50,000 to left hand side, it will be added. So first I'm going to multiply by 50,000 because of the denominator, and then I'm going to add 50,000 because of the numerator. So it will look like this: 148,312.50 NAV 3 into 6271.98. Let's calculate NAV 3 now. That comes to 23.65. Let me check if this is correct in the answer by the institute. 23.65. Okay with this? See, they have given it in one shot, but you should understand what is exactly happening there. What you should understand, right? So if you go properly with the formula, and if you will remember, in the second question of the mutual fund, you have learned about this formula. I will tell you one thing. The first question of the mutual fund was on this formula. So NAV1 is calculated based on the first question of the mutual fund that we have seen. And the third question, the third part of this answer of this question is used in the second question itself. So the first and the third question was very easy. First and the third part of this question depends on the is taken from the first and the second question of the mutual fund of this chapter. Only the second one was little trickier, which you had to like give proper time. Otherwise it's easy. So these are the three NAVs. Do you get that? Try some questions. See, this was the first question, and it's okay if you don't get it 100%, but like with 100% confidence, try solving some questions. There are three questions for practice. If you solve all of them, you will be I think you will get some confidence in this type of question. Otherwise you will see that the first and the third parts is very easy. You just put the formula values and you will get the answer. But the main point is not getting the answer. The main point is to know this formula is applicable in the third part or the first part. Even if you don't even remember what exactly I have to do, doing is easy, but you should know what exactly you have to do, right? So this is the question that we have finished right now. The capital gain treatment is not given in the previous question. So in the previous question, in the second part, there is no capital gain, there is only dividend. So that's okay, that's totally fine. If the dividend is given, then you will assume the capital gain is 0. In the first part of this question also, we did the same thing, right? So question number 34 is over. Let's come to question number 35. This is an interesting question. So let's take the question number 35. There are two mutual funds, D mutual fund, K mutual fund, each having close-ended equity scheme. Okay, let's wait. Let me just check whether I should take 35 or 36. Which one? Both of them are exactly same. So let's take 35. So there are two mutual fund, D mutual fund, K mutual fund, each having close-ended equity scheme. Close-ended. NAV as on 31st December 2014 of equity schemes of D is this much and K is this much. Now please understand, in this NAV, 99% of the assets are equity and the remaining assets are cash balance, no liabilities. Consider there is no liability. And that of K mutual fund, out of this 62.5, 96% is equity and balance is cash. Okay. So what are we going to do? We are going to first bifurcate how much is equity and cash in both of them. So let's start with this first. You write down the two mutual funds, write down the NAVs given in the question and the component of equity. Bifurcate the component of equity. 99% of 70.71 is 70 rupees. So in this, 70 rupees is equity and 0.71 is your cash. Okay. So this is the starting point, decomposition. And out of this 96% is the equity. So 60 rupees is the equity, 2.5 is the cash. Now remember these two figures. How much is equity and cash in each of them? Let's move ahead. Following information is given to you. For the D mutual fund and the K mutual fund, Sharpe ratio, Trainer ratio and Jensen's standard deviation is given to you. So let's first write down what exactly is the Sharpe ratio. It is Ri minus Rf divided by standard deviation of I. Am I right? We have just completed the portfolio management chapter and I'm expecting that you remember the formula. And the Trainer ratio is very simple. It is exactly similar to the Sharpe ratio, except for the fact that Trainer says that the premium should be compared with the beta only, not the total risk. So we will take the beta and the standard deviation is given. Okay. So we have this figure given. Sharpe ratio is also given. What exactly can happen with this? See, we have not been given with Ri minus Rf, let's say. So we can calculate with the help of Sharpe ratio. I will keep the standard deviation here and the Sharpe ratio is, let's say, 2. Can I calculate Ri minus Rf? Exactly. I will calculate Ri minus Rf and I will keep that Ri minus Rf in this figure. And what is the purpose? When I keep this in trainer ratio, 15 will be this 15 will be outside left hand side, Ri minus Rf will be taken from the Sharpe ratio. I will get to calculate the beta. Why I need the beta? Because I want to find out how much exactly the equity has changed over a period of 1 month. The closing NAV, if we have to calculate, I need to make sure that beta is calculated. Beta is exactly used to find out the new NAV, because this is the equity element of NAV. 70 rupees is the equity, and if the beta is 1.2, so 70 multiplied by 1.2, something or like this will happen. How much is the market changing is also important, right? It is given in the question. Now, there is no change in portfolios during the next month, and annual average cost is 3 rupees per unit for the schemes. Cost, it's an expense, and that is annual. So 3 divided by 12, monthly cost is 0.25 only for both the units. So that is the only cash outflow. See, 0.71 less 0.25, 2.50 less 0.25. So the closing cash balance is ready. You need to make sure this thing, that the annual cost is given. Do not deduct 3 rupees from this cash balance, because this cash balance has to be, the new cash balance has to be calculated by the end of the month. So we have opening and closing. So we need to just deduct 1 month's cash, 1 month's cost, that is 0.25. Okay, so 0.71 minus 0.25 goes to 0.46, and this will be 2.25. So these are the new cash balances by the end of the month. And we just need one more thing, equity element, to calculate the NAV for the end of the month. Have a look. Now, if share market goes down, market is going down by 5% within a month, calculate expected NAV after a month for both the schemes. That's it. The NAV, expected NAV, will include two things by the end of the month, equity and cash only, because it includes equity and cash at the beginning as well. So at the end also it will include the same thing, because question says there is no change in the portfolio. So no liability, nothing else, no other thing is there. Okay. So you just need to find out the value of equity and the value of cash by the end of the month. So we have calculated the value of the cash, figure of the cash. And how to calculate the value of equity when question says the market is going down by 5% and you have been given with the Sharpe ratio and trainer ratio, you should get to know one thing, that this equity value that we have calculated can be changed with only one figure, which is beta, because the market change is given to us. So you need to calculate beta. Beta is calculated with this formula. In this formula, we know the trainer ratio, we don't know Ri minus Rf and beta, and we need to calculate beta. And for this purpose, we need Ri minus Rf, which can be calculated through the Sharpe ratio. So what is exactly going to happen? With the help of Sharpe ratio, you are going to calculate Ri minus Rf and put it in the trainer ratio. You are going to calculate beta, and then you will apply it to the equity element. You will calculate the new equity and add it to the cash balance to get the new NAV. Have a look. So what I did with the D mutual fund is we calculated the Sharpe ratio. Ri minus Rf came to 22.50, and then we put it in the trainer ratio to calculate the beta of the D mutual fund, which is 1.50. See, the market is going down by 5%. So the equity component of D mutual fund should go down by 7.5%. Are you ready to make this change? Right. Let's start with the K mutual fund. We calculated the Sharpe ratio to find out what is Ri minus Rf. We put this Ri minus Rf in the trainer ratio to find out what is beta, and the market is going down by 5%. How much do you think the equity component of K mutual fund should go down by? 5.5. That's the reason. Okay. Let's start 7.5, 5.5. Now, this is the closing cash balance. Are you good with this? 0.46 and 2.25 we have already calculated. Please make sure that the expenses per month is 0.25, that is 3 divided by 12. You should not make a mistake of taking it a negative cash or taking it on a per annum basis. Now, equity component was 70 at the beginning and we have to reduce 7.5%. Why reduction? Because the market is going down, beta is positive, equity will also go down. Positive beta means the same direction, negative beta means the opposite direction. So the equity component will also go down by 7.5 and 5.5%, 7.5 and 5.5. This is for the D mutual fund. This is for the K mutual fund. This is the new equity component. This is the new cash balance. This is the new NAV. The thing that you did in the beginning was decomposition of a particular NAV into equity and cash, so that you can calculate the closing equity and cash and add it back to get back the NAV. Get it? Okay, sir. So this is going to be the procedure. NAV was first decomposed into equity and cash. Okay. From the cash you deducted expenses to arrive at a new cash balance, closing cash. And in equity you have to make a change with respect to beta. We can say you have to adjust the change. The change is calculated by calculating beta and change in the market. You know this figure, but beta has to be calculated by this formula. Trainer ratio is equal to Ri minus Rf divided by beta. Now in this also you know the trainer ratio, you know the you have to calculate the beta, and for that purpose you need to calculate the Ri minus Rf. Now Ri minus Rf will be calculated by you using the Sharpe ratio. So take the Sharpe ratio formula, Ri minus Rf divided by standard deviation. Now you can clearly see this is given to you, this is given to you. You can calculate the Ri minus Rf, and if you go step by step, start with this, calculate Ri minus Rf, put it in the trainer ratio, calculate beta, put it in the change to market, and then put the change in the equity. Simultaneously calculate the closing cash balance. You have the closing equity. Add back both of them and you will get the closing NAV. That's the procedure. Okay, question number 36 is exactly similar. You can see NAV is given, Sharpe ratio, trainer ratio, standard deviation is given, monthly cost is 0.50. They have already given the monthly cost. Share market is going up by 2%. Okay, and you are required to calculate the expected NAV as on 30th September. See, you started on 31st August and the 30th September. That means for 1 month only. So exactly same question is this. So 36 is your homework. Let's go to 37 now. So have a look. Question number 37. ANP Plan is a hedge fund. Currently has assets of 20 crore rupees. Hedge fund, which takes lots of risk. CAX, the manager of fund. You remember the manager of the fund in the very first video? I told you that this person is the manager of this Tata mutual fund, or I think whatever the mutual fund was. So this is a hedge fund which has an asset of 20 crore rupees, and he is the fund manager who charges a fee of 0.10% of the portfolio assets. Okay. In addition to it, that's not just the only thing that he is charging for managing 20 crore rupees. In addition to it, he is going to charge an incentive of 2%. Incentive is given when you do something great, right? The incentive will be linked to the gross return each year. Gross return each year. Return, not the value. In excess of the portfolio maximum value since the inception of the fund. So there is one benchmark. If you go beyond this, so whatever amount that you have gone beyond this, that will be considered as eligible amount for the incentive of 2%. Now the question says that it is in excess of the portfolio maximum value since the inception of the fund. So from the starting of the fund, the moment you started the fund till date, from that date, from the starting point till date, highest value of the portfolio will be considered as the benchmark. And now if you cross that amount at any point of time, the difference amount will be considered for the incentive. And the maximum value the fund has achieved so far since the inception of the fund was 1.5 years ago, 21 crore. So this is the highest this fund has gone. Okay, right now it is at 20 crore, but 1.5 years back it went to the highest point, which was 21 crore. Now if you can get this fund beyond 21 crore, then the balance amount, the 21 minus the new figure, the difference between these two will be eligible for the 2% incentive. Now, you are required to compute the total fees payable. The fees payable will include two things only. First one will be the fixed charges, which is 0.10%, right? Plus incentive. Okay. If the return of the fund this year, the return of the fund is this much. So if you are earning 29% on 20 crore, 4.5% on 20 crore and minus 1.8% on 20 crore, what will be the total fees payable to Mr. X? So first of all, calculate what is the current value after this earning. So add 29% in 20 crore. It comes to 25.8. This is the current value if the return is 29%. 20 plus 4.5%, that's 20.9, and 20 minus 1.8%, 19.64. Now, understand the fact that in order to be eligible for the incentive, your portfolio value should cross 21 crore. In the second and the third part, it is not crossing that limit. So in the second and the third part, you're not going to get any kind of incentive. The incentive is 0, 0. Only in the first part, you will be getting the incentive, and that to 25 minus 25.8 minus 21 crore. That is 4.8 crore into 2%. I told you, in excess, see, in excess of the maximum value. The maximum value was 21. So the return is 4.8. So how are you going to calculate 4.8 into 2%? 4.8 into 2%, that goes to 0.096 crore. That means around 9,60,000 rupees. That is going to be the incentive. But apart from the incentive, 0.10% of the portfolio assets is worth 20 crore will be your fixed charges. So 0.10% of 20 crore comes to 0.02. So 0.02, 0.02 and 0.02. The total will be written here. 0.02 plus 0.096, that's 0.116, that is 11,60,000, and this is only 2 lakh, this is only 2 lakh. So this is the final answer to you. See, 11,60,000, 2 lakhs and 2 lakhs. That's it. No incentive in this case. No incentive. 2 crore fixed incentive. New fund value 25.80. You calculate the additional value, which comes to 4.8, and on 4.8 you will get 2%, which comes to 9,60,000. So the fixed fee plus 9,60,000, the total fee is 11,60,000. Here the amount is not going this 20, not crossing the 21 crore. So that's why no incentive. In this case, obviously you are losing money. You are not earning anything. So there is no chance of going beyond 21 crore. So no incentive, only the fixed amount. There is one ambiguity in this question. You might be saying, you might have a view that the 0.10% of the fee of the portfolio asset that he is getting should be on the current value, which is 25.8, 20.9 and 19.64. And I also agree on that the fees of fixed payment which he is getting should be on the current value. But in this example, they have calculated 0.10% fixed on 20 crore itself. What if this value goes down and it is and only 5 crore is left in the portfolio asset? Still you are going to pay him 2 lakh rupees. When the person has brought 20 crores portfolio to 5 crores, still you will be paying only paying 0.10% to him on 20 crore. No, that 20 crore is not that 20 crore which is currently this is the current value of the assets, and that 20 crore will not be relevant after a year. So my opinion on this is 5.8 and 20.9 and 19.64 should be considered for the fixed amount. This is the fixed. This is also a fixed fee, no? 0.10% is fixed of whatever you will make the portfolio. If you go down, you will get less amount. If you go up, you will get higher amount. That's it. So 0.10% should be calculated on this amount. That's my opinion, but institute has not done it. So practically keep the correct approach in your mind so that you can do it in your life. You can get a proper approach and proper action you can take in your life. But for the exam purpose, till the institute doesn't correct this answer in their study material, follow this approach only. And at the max, if you have a time after writing all the answer, you can just start with alternative answer and give the proper treatment. So you can go with both the answer, you will get the marks for sure. But please make sure follow the institute's approach for the purpose of marks. Keep the correct approach in your mind for the purpose of life. This happens sometimes in the institute's material, that the answer is wrong, but still we have to follow it. We cannot help it. But please make sure that you follow institute's answer. Are you okay with this? Shall we move ahead to question number 38? It is an interesting question. Have a look. Bluetooth Mutual Fund is planning to float a fixed income fund of 100 crores on 1st January 2015 with a term of 7 years. So the lifespan will be 7 years. If the target duration, underline the word duration, write down MACD. This is a Macaulay's duration. The target duration of the fund is 5.5 years and has expected rate of return of 8%. This is going to be YTM. Consider this question as more of a security valuation question than mutual fund question. Why I have put this in the mutual fund? Because of this mutual fund related wordings in this, but I think I should shift it to the security valuation chapter. That's okay. In the next time we are going to do the same thing. Then determine the amount of interest it has to earn annually. This interest will be the coupon amount on its investment of 100 crore. After defraying means payment, after paying management expenses of 10% of the amount of income earned, that is coupon. So basically they are asking us to do the reverse calculation and find out the coupon rate. That's it. It is as simple as it is. Now understand, in order to calculate the duration, you have learned about 3 different formulas. What was those formulas? Summation of present value, you can say summation of weight of the present value into years. Second, summation of present value into years divided by summation of present value. Third is that biggest formula. Now what exactly they have done in this question, you can clearly see, let annual inflow after defraying the management expenses be X. So they have kept the cash flow as XXXXXX for 2021, and for the same period they have given 100 also. At the end this will be the redemption, face value, at face value this will be redeemed. Okay, now they have taken 8% as the YTM. So the discounting factor has been calculated on this 8%. And then you are calculating the present value factor into inflow and then present value into years. So this formula of duration is nothing but summation of present value into year divided by summation of present value. So you can calculate the X with this also, but it is going to take a lot of time in exam. I will give you the shortcut method for calculating the same answer. Let's do that. You remember the formula. The only difficult part is this. You need to remember the formula in that case. So it's 1 plus YTM, if you remember that, divided by YTM minus 1 plus YTM plus time outside coupon minus YTM divided by coupon outside 1 plus YTM to the power T minus 1 plus YTM. So if you are good at remembering the formula, this is going to save a lot of time to you. But even if there are 20% chances that you are doubtful of remembering this formula, then make sure that you follow this approach only. Summation of present value into year divided by summation of present value. This is going to take some time, but the marks are ensured. So obviously investing 5 minutes will be very a good decision. Extra 5 minutes, 5 to 7 minutes will be a very good decision to ensure the marks, rather than making a mistake here in the formula for plus minus signs. Even if you make a smallest of the mistake in this formula, you will lose all the marks. So you cannot take chances while using this formula. You can easily remember this process at least. So let's start with 1.08 divided by 0.08. Why I am taking this formula? Because one of the method is already given to you here. I am teaching you the second method. So whatever method suits you, go with that. Minus 1.08 plus time is 7 years, coupon amount we don't know, YTM is 0.08, right? Divided by coupon amount we don't know, 1.08 to the power 7 minus 1 plus 0.08, and the duration is 5.5. The answer is known to us. Let's start solving this. It comes to 13.5 minus 1.08 plus 7c. When I multiply the 7 inside the bracket, let's open the bracket. 7 into 0.08, so that's 0.56 divided by, now inside the bracket 1.08 into 6 time, because 1 time is already written in the calculator. 1.08 into 2, 3, 4, 5, 6, 7. Calculator. So that is going to be 1 and minus 1. That's 0.7138c plus 0.08 is equal to 5.5. Now if you will transfer this entire minus sign and this entire statement on the right hand side and bring this 5.5 on this side, so then minus sign will get converted to plus sign and this plus sign will get converted to minus sign. So 13.5 minus 5.5 will be 8 is equal to, have a look, 1.08 plus 7c minus 0.56 divided by 0.7138c plus 0.08. Now bring the denominator on the left hand side and multiply it with 8. So 8 into 0.7138, that goes to 5.7104c plus 0.64 is equal to, now understand this, 1.08 minus 0.56, 0.52. Okay with this? Plus 7c. Now bring all the c related values on one side. So take this one, because this is the smaller figure than the 7 now. So take this one on that side, 0.52 on this side. So 0.64 minus 0.52, it will look like this, 0.12, and 7 minus 5.7104, it will be 1.2896c, and the c will be 9.305%. You can write it as 31% directly. The answer is here. And this is a post management expense. See, I will tell you how. How did we know that this is a post management expense? Because we have not given any kind of a treatment related to the post management expenses. Then sir, how you can be assured of this figure 9.31% is a post management expenses? I will tell you. Management expenses is basically the expenses salaries related to the management for managing this entire portfolio, right? Now understand one thing. The return that they are saying has an expected rate of return of 8%. The return is always given to the investor after deducting all types of expenses. Now if we are taking 8% here as a discounting factor or 8% here as a YTM, that means what? All the expenses, not just the management, all the expenses has been deducted and then 8% is calculated. So if 8% is taken into this consideration, that means this is after deduction of all the expenses. So whatever the figure is arrived after taking 8% into consideration, we will call that also 9.31%, which is called also as post management expenses, because return is also after all the expenses. The values derived by 8% will also be considered as post management expenses. That means 9.31% is something that you have to earn after paying the expenses. That means you have to earn a little more than that, because in order to make the payment of 10% of the management expenses, this is not sufficient. This is sufficient after the payment has been done. So let's say, for example, you are earning 100 rupees and the 10 rupees is the management expenses. 90 rupees is what 9.31% is. So in order to calculate the earnings for making a payment of management expense as well as the investor, then you have to find out this figure 100. Right now we have arrived at this 90s figure. So what we are going to do, 9.31 divided by 90%. If you do that now, 9.31 divided by 90%, you will get a 100% figure. That means 10.34% is the figure that you should earn. What is going to happen? If you earn 10.34%, out of that 10%, that means 1.034 will be the management expenses, and the balance, that is 9.306 or 31 you can say, will be the investors return. Investors return is 8%. Please understand one thing. Investors return is 8%, but when he will be getting 9.306 of the coupon on 100 crore, na, that automatically will become 8% to him. So 9.31% is the coupon rate. Coupon rate after that 10% of, understand, after that 10% of the management expenses. So I will tell you one thing, the actual coupon rate is 10.34%, because after earning this, from this earning you will have to make the management expenses, and then the balance will be left for the investor. Do you agree with this thing? So this is what the logic is. So you can go with this formula as well, and you can go with this equation as well. Both will give you the same answer. This is more of a security valuation because no other concept of mutual fund has been used in this question. So I'm going to make sure that this is shifted to the security valuation chapter next time. Shift to security valuation. Okay, now is the time for the last question, sir. Question number 39 and question number 40 are pretty much similar to each other. Let me just check once. No, both of them are different. So let's first take the 40th question is very easy, but question number 39 is something which you need to focus a lot on. You can take a break, but you can take a break if you don't want to take a break. I am going and I am taking a break. I will just go downstairs, open the kitchen. Right now it's 10 p.m. in the office. So right now I'm sitting. Why I'm sitting? Because there are only 2 questions left and I want to go home with the satisfaction of completion of the chapter. But I don't want to do it in a hurry because this is the most important question of the entire chapter. I will just take a break of 5 minutes, not 5%. Go to the kitchen, bring the cup. I will just boil water, put a green tea in that. We'll rest for 5 minutes. The match is going on. I might see the score and then I will be back with question number 39. See you till then. So welcome back, my friends. This is going to be second, or we can say second last question of the entire chapter of mutual fund, and we are going to enjoy this question and learn a lot of things. Please make sure that you have 100% focus while listening to me on this question. Let's start with it. On 1st January 2020, an open-ended scheme of mutual fund had outstanding units of 300 lakhs. The very first thing is the open-ended. Open-ended itself means that right now 300 lakhs are outstanding units. But in the coming time, at any point of time, we can increase this number, because if the investors are coming into this mutual fund to invest, we are going to issue new units to them. So it can go to 303 lakhs, 306 lakhs, or it can be reduced as well if unit holders wants to sell off the units that they are holding right now. So this open-ended itself means that the 300 lakhs number which is outstanding at a particular point can go up and down as well in the coming time. With a NAV of 20.25, this is the net asset value at 1st January 2020. At the end of January 2020, means after 1 month, it had issued 5 lakh units at an opening NAV plus a load of 2%. When you are issuing new units, that means you are charging this as an entry load. And it is clearly written that you will be issuing it at opening NAV, which was 20.25 opening of the month, plus a load of 2% adjusted for dividend equalization. And this is something new that you are going to learn in this question. At the end of February 2020, that means 1 more month after, it had repurchased 2.5 lakh units. Who? The mutual fund had repurchased 2.5 lakh units from the investors at an opening NAV. Again, opening NAV itself means this 20.25. So the information is not given that much. So what they are doing is, for at the time of issuing also this NAV is used, at the time of repurchase also this NAV is used. Less 2% exit load. Why less? See, here we have added the load and here we have deducted the load. Why? Because I will tell you, at the time of issuing the units, you are going to ask for the money from the investor. So NAV is an inflow at this point of time to the mutual fund, and entry load is also an inflow. Both of them are inflow, that's why plus sign. But at the time of selling off or repurchase, this NAV is an outflow to the mutual fund, but exit load is still the inflow. It is the inflow in both the cases. Again, adjusted for dividend equalization. We'll talk about it in a moment. So this is how they have given. Let me just write it down. Question number 39. Let's frame a time. So this was January 2020, 1st Jan. This is 31st Jan, means at the month end. This is 28th February, right? And by the end of the March, so that's 31st March. Okay. The NAV on this date was 20.25. The number of units outstanding was 300 lakhs. Okay. Can I say the net assets on that date is 6075? Right, sir. 6075 lakhs. Sir, net assets also include some cash balance and reduction of the liabilities and everything else. But I agree on this point, but there is nothing else given in this question apart from this figure. And this is the net asset value itself. So we will assume that everything has been adjusted in 20.25. This becomes the opening assets of the mutual fund. Now what has happened? Let's just focus on that. By the end of the first month, 5 lakh units has been issued. How many units? 5 lakh units has been issued. So the number will be 305 lakhs at that point. And this has been issued at a price which is opening NAV, which will be received by the mutual fund, plus entry load received by the mutual fund, plus dividend equalization reserve. I will talk about it in a moment. This is going to be your issue price, the price at which you have issued 5 lakh units. Cool. But at the end of the next month, you have repurchased how many units? Around 2.5 lakhs, the half of what exactly you issued a month back. You have 2.5. So 305 less 2.5 means the balance unit at this point will be 302.50. And the condition is this is going to be an outflow for you. You are repurchasing, that means you will be paying back the investors their NAV less exit load. But this is your inflow. So NAV will go, exit load will be an inflow to you, and dividend equalization reserve will also be an outflow to you. Or in other word, we can say that for you it's an inflow. For you this is an outflow. Okay, that's cool. So this is going to be repurchase price. Getting it? Okay. Since this is an inflow and this is an inflow, that's why we are adding both of them. This is an outflow, this is an inflow, that's why both of them will be deducted. Okay. This is a repurchase price. Now, what else is given to us? At the end of March 2020, it had distributed 70% of its available income. Whatever the income is available, 70% of it has been distributed. Distributed to whom? The investors as a dividend income. Okay. In respect of January to March quarter, the following additional information is given to you. You can see that for the entire quarter of January to March, the portfolio value has appreciated by 460 lakhs. And the portfolio value at the beginning of the quarter was 6075 lakhs. Can I say it is 6075 plus 460 lakhs at the end. So can I write down like this? 6535 is the total net assets at that point. Okay, good enough. Then income for every month is given to you. 24 lakhs, 36 lakhs and 47 lakhs. Okay. Then some things are asked. Few things have been asked in this question. Income available for distribution, and it is very simple. Available for distribution means if you have earned 100 and have distributed 70, that means 30 is still available for distribution. So that is what you have to calculate. Track down all the incomes, all the income that you have received, deduct 70% of that at the end of the March, and the balance will be income available for distribution. First thing. Second, issue price at the end of January. That means this is the second thing that you have to calculate. B. This is the third thing that you have to calculate. C. And closing value of net assets at the end of the March. Closing value of the net assets includes 6535 less some cash balance and everything which you might have received throughout the process. So we'll talk about it at the end. But there are four different parts. First, income available for distribution. Second is the issue price. Third is the repurchase price. And fifth is the net assets at this point of time by adjusting something in 6535. Before starting the question now, I will just take a moment to explain the dividend equalization reserve, because everything else, the entry load, exit load, NAV, net assets, is familiar to you except for this particular concept of dividend equalization reserve. So let's start with it. Now what happens in a normal sense is, this is an investor. What he does is he invests in the mutual fund. Let's say this is a mutual fund, and this is a market where the mutual fund is investing its money. Now what happens is, you pay money, you give money to the mutual fund will invest it in the market. Now after that, what will happen? Market will, after, let's say, by the end of the year, market is paying some dividend. How much? Let's say the market is giving a dividend of 12. Let's keep it simple. 10. Let's keep it 15 on a safer side. So market has given, market means the investment where the mutual fund has made the investment. Those investments has resulted into a dividend of 15 lakh rupees, crore, whatever you want to take. Out of this 15, mutual fund is going to distribute the dividends to the investors as well. But what happens is, they are not going to distribute the entire amount. They will distribute lesser than that. I will tell you why. Let's say the dividend distribution is 12. Okay. Next year, okay, can I say one thing before starting the next year? Can I say that the 3 has been reserved by the mutual fund? The dividend income of 3 lakhs is reserved by the mutual fund in a dividend reserve account. Okay, has been kept in a reserve. So reserve is created for the bad times. You will understand the logic in a moment. Now again, the next year, let's say mutual fund has distributed dividend of 15 lakhs and mutual fund has paid the dividend again of 12 lakhs. So 3 additional lakhs are added, now have been added to the reserve. So the total of the reserve, dividend reserve account with the mutual fund is 6 lakh rupees. Okay. Now what happens is, let's say the third year, the market was bad, giving a bad results, and it paid only 10 lakh rupees as a dividend. And now you will see the magic here. The mutual fund will still be paying 12 lakhs to the investors. Why? Why they paid 12 lakh rupees to the investors when they received only 10 lakh rupees? And how are they going to pay the extra 2 lakh rupees? They are going to pay that from the reserve that they have been created from the last 2 years. This process is done because let's focus on one thing. Mutual fund has to keep a stable income, keep giving a stable income to the investors. Okay, irrespective of the market's ups and downs. Market can go up and down, right? So market can be sometimes very good, market can give you worst return as well. So in the bad times, what is going to happen? The reserve that you have been created from the last 2 years can be used to pay a regular income to the investors. Now the question is why? Why we are not paying only 10 lakhs or less than 10 lakh rupees to the investors? Because see one thing. Now what happens over a period of time by looking at the pattern? The investors and the public relies more on this mutual fund. We can say that mutual fund is able to build a trust and gain confidence of the investors and the public because of the stable income from the last 10 years. Let's say they are paying 12 lakh rupees, and because of that the demand of the mutual fund will increase. Lots of people would want to invest in this mutual fund, and ultimately the NAV will also increase for the mutual fund. That's it. Okay, understood the reason why the mutual fund has to keep paying the regular income, and it has made sure from the very beginning that some of the amount should be kept in the reserve, 3 lakhs, 3 lakhs, 3 lakhs, 3 lakhs, so that that reserve of 6 lakh rupees can be used in the bad times. So this is why the dividend reserve is created. Now you are okay with the concept of dividend reserve. It is created for the purpose of continuing the stable income to the investors, even if the market is not giving that much returns. Cool. Now this dividend reserve is okay with you. Now let's focus on other thing. This is a timeline. Okay, let's assume that the mutual fund has a habit of paying the dividend of 12 rupees every year in December 31st. Okay, and you are, let's say this is an investor. On January he has purchased some units. He waited for the entire year to receive 12 rupees. Why? Because he knew the pattern. He knew the pattern from the last 10 years. The mutual fund is paying 12 lakh rupees or 12 rupees per unit. Let's say 12 rupees per unit in the month of December. So he waited for the entire year to receive 12 rupees. Okay. Then let's say there is another investor. Investor's name is B. And at the end of the October, he has also purchased the units of the mutual fund. Now, what is going to happen? What is going to happen at the end of December? At the end of December, this mutual fund will pay dividend to both of them. That is 24 rupees. Because mutual fund will not keep a track of who purchased the units every minute and who is selling the units every minute and then settling of the dividend according to that. No, this does not happen in the equity share as well, and this is not going to happen in the mutual fund as well. They are not going to keep a track of it because every second the units and the shares are purchased and sold. So we cannot keep a track of that. What happens is that we set a particular date, let's say 25th of the December. Okay, on that date, whosoever will be the unit holders of that mutual fund, they will be entitled to receive the dividend. Now, on that date, whosoever will be the unit holder will get that dividend. So B was also the unit holder on 25th of December. A was also the unit holder on the 25th of December. So both of them got 24. But don't you think this is somewhere unfair? A waited for the entire year and he received 12 rupees. B waited only for 2 months, November and December, and he also received 12 rupees, right? This is one unfair point for A, and B is taking the advantage of that. There are some, because of this pattern, there are people who are smart enough. They are going to buy the units of this mutual fund in October and sell off the same in January. See, in October, lots of people will start buying the units of this mutual fund. So mutual fund will get lots of money in this October, and in January, after making the payment of dividend in January, this might happen that lots of unit holders will sell off their units and get back their money. So in this period from October to January, this mutual fund will have a lot of money. But from January to October, there is no demand for the mutual fund, because they knew that there is no point in keeping money with the mutual fund in this period if we are getting the same amount of dividend, right? And just to make sure that this loophole is not being taken into this loophole is not used by the investors in the market, what happens is that when B comes in the October month to buy the units, focus on that, he will have to make a payment of NAV plus entry load plus dividend equalization reserve. Means dividend for the last 9 months will have to be paid by the B as well. How much? If 12 rupees is the dividend for 12 months, for the 9 months it will be 9 rupees. So what happens is that B will have to contribute this dividend of 9 rupees, and there is no loss for him in that, because anyhow he is going to get 12 rupees. By the end of the year he will get 12 rupees. So this is an outflow. 12 rupees will be an outflow to the mutual fund. 9 rupees will be an inflow to the mutual fund. Practically speaking, mutual fund will make sure that B gets only 3 rupees. Because sorry. That's my mistake. From January to October, it's 10 months. So the 10 rupees will be paid by B if he wants to buy the units. And the mutual fund will make sure that he gets 12 rupees at the end of the December. And the mutual fund will be making sure this thing that the ultimate dividend that he is earning is only 2 rupees. He paid 10 rupees in the beginning. He received 12. That means he is getting only 2 rupees for the months that he has been a unit holder with the mutual fund. Now, because of this, what is going to happen? Nobody is going to take the undue advantage of buying it in October or the last months and selling it just after the dividend is paid. Now you come to any point of time and buy the units. You will have to make sure that you are paying the dividend equalization reserve. Mutual fund will make sure that this person A is starting with the January. He don't have to pay any kind of a dividend equalization reserve. He can wait for 12 months and he will get 12 rupees. He can wait for 2 months. He will get only 2 rupees because of this amount. Did you get that concept of dividend equalization reserve? This is why if you buy the units of this mutual fund, you will pay NAV, you will pay entry load, you will also pay dividend equalization reserve. All these three will be an income will be an inflow to the mutual fund. Now let's talk about the outflow part. See, here it is an inflow. Do you get the logic of this now? Right? You will pay NAV, you will pay entry load, you will pay dividend equalization reserve. Mutual fund is going to collect all of this. And this dividend equalization reserve will be for a period of January, the past period, right? Now, why the dividend equalization reserve is paid to the investor in this case? When we are repurchasing the units, let's say focus on this part. Let's say this A, this person, due to some or the other reason wants to quit by March. He wants to sell off his units. So practically speaking, he was the unit holder for 3 months. And don't you think that he should be receiving 3 months dividend of 3 rupees? Yes, we know that he should be receiving 3 months dividend practically. But the dividend is only declared by the mutual fund in the month of December, so there is no point in giving him dividend separately, right? So what is going to happen at that date? At that date, when the mutual fund is going to buy back his units, because he is selling, mutual fund is buying. So mutual fund will pay him NAV, whatever the NAV was going on, minus they will deduct the exit charges, and they will also pay the dividend equalization reserve, that is 3 rupees. So they will just pay it from the reserve, 3 rupees. So this will make sure that he is getting his due amount for the 3 months. So that's why he will be paid for the same reason why why the investor has to contribute while buying the units. The investor will get as an income while selling the units as well. So this is an outflow to the mutual fund. NAV is also an outflow to the mutual fund. Exit load will be an inflow to the mutual fund. Exit load and entry load will always be the inflow to the mutual fund. So do you get the logic of this equalization part and all that? I have given some notes to you for reading if you want to from my previous batches. So this is a concept of dividend equalization reserve. If you want to read it, just have a look on this. Income received by mutual fund from investment in market is not distributed entirely to the unit holders. I told you from 15 rupees, 15 lakhs in mutual fund was distributing only 12 lakh rupees. Some part of it is transferred to the reserve. This is just like putting aside a portion of income so that it can be used to distribute to the unit holders in bad days. It means the time when mutual fund receives no or less income from the market. Okay, this was all about the reserve. Let's talk about the concept of equalization. Suppose it is apparent from the history of the mutual fund that every year in the month of December, mutual fund distributes dividend. Also, dividend declared is same for all unit holders irrespective of the date of investment. I told you that if someone is buying in October and someone is buying in January, both of them are getting 12 rupees of the dividend. Right, that is a bad thing. In order to leverage the opportunity and receive dividend, many investors will purchase unit just before the dividend is declared, that means in October, and sell units just after the dividend is received, that means in January. This is a kind of unfair for those unit holders who waited for entire year for the dividend. In order to remove this loophole, additional unit holders are also required to contribute to the dividend equalization reserve along with NAV of the time of purchase and sell. Got it? Let's now focus on the question. I hope it is very much clear to you now. We will start with the calculation of income available for distribution. But before that, we will have to make sure that we calculate the issue price as well and the pre-purchase price. Now focus on this one. Let's find out the issue price now. What was the issue price of 5 lakh units on 31st January 2000 whatever? So NAV was opening NAV. So can I write down 20.25 opening NAV? And they said that they are charging the entry load of 2% plus a load of 2%. So the load of 2% plus 2% load. So 20.25 into 2% comes to 0.405 plus dividend equalization reserve. How are you going to calculate the dividend equalization reserve? We will talk about it later. But let's come to this point, 20.25 and exit load. Exit load is 2% again. So less 2%, 0.405. So we will have to first calculate the what we can say, the income that has been received in this particular area, and then we will call for the contribution by the new unit holders for that income. Okay, let's start with this part now. Please pay careful attention to this table. I will explain each and everything. I'm not going to create a table because exactly what is required is given here. Income from the January. We had 300 lakh unit at the opening. Okay. We received 24 lakh rupees. See, in the month of January. So if we want to calculate, we received 24 lakh rupees and at that time the unit holders were 300 lakh. So for the entire month, how many units were holding the unit? How many investors were holding the units? 300 lakhs. So don't you think this 24 lakhs is entirely the income of these people? Right? So what you do is 24 divided by 300, you will get the per unit income that comes to 0.08. So this is what the income of 300 lakhs unit holder. Now on this date, if 5 lakh additional unit holders are coming into the company or the mutual fund, do you think this 5 lakh unit holder should get a share out of this 24 lakh income? No, sir. Because they are coming today. They will be getting a share in the future income but not in the past income. but practically mutual fund will not make a difference at the time of selling. So what mutual fund will do is, whatever the per unit income is for the 300 lakh unit holders, which is 0.08, mutual fund will make sure that this 5 lakh unit holders contributes that much of the amount 0.08 to the mutual fund. So while coming into the mutual fund, they will have to pay 0.08 as dividend equalization reserve for every unit, because every unit's income in the month of January was 0.08. Now, at this point, if anyone is coming and buying the units of mutual fund, they will have to make sure that they are contributing for the past income as well. So 0.08 will be contributed by them. So they will come into the picture, they will contribute the income of 0.08. Now what is going to happen? See, 0.08. So they will pay 20.25. This will go into the entry load charges and this will go into income. So the total issue price will be 20.735. Let's just check that if it is correct or wrong, and then I will show you. See, do you get this? 20.25 pay additional charges as entry load and 0.08 as dividend equalization reserve. Do you get that figure 0.08? Because the time at the particular time at which they are coming into the picture, this 5 lakh unit holders, already the old unit holders were having per unit income of 0.08 into their share, and they don't want to share their income with the new unit holders. So what exactly is happening is, these unit holders are bringing that much of the income and putting it in the total. Now 305 lakh unit holders, previous income of 24 plus 0.08 means 5 into 0.08 means 0.4 lakhs. Now you will see the mutual fund will have a balance of 305 lakh unit holders and an income of 24.40. The income has increased automatically because 5 lakh unit holders has contributed to the income as well. Now if you divide 24.4 by 305, it will come to 0.08 itself. Now everyone can get 0.08 at this point of time. Cool. See, 24.4, 305.08. This is the closing figures of the number of units, total income and per unit income by the end of January. This is 31st Jan. Are you okay with this? Now from this point onwards, what happens is, for the next month, for February, 36 lakhs is the total income. Now 36 lakhs is the total income earned by the mutual fund. Let me tell you one thing, or let me ask you one thing. Who do you think, or how many unit holders do you think has the right on that 36 lakh rupees of the income? All the 305 lakh unit holders will have the right on this 36 lakhs, because this is the income of the February, and for the entire February 305 lakhs was the total balance of the unit holders. Now 305 lakhs, 36 divided by 305 lakhs will give you per unit income of February. Per unit income of February, right? But that's not enough. This 36 lakhs will be added to 24.40 lakhs, and then you will get the total income of both the months, which comes to 60.4. So for both the months, you can say 60.40 is the total income and 305 lakhs was the total unit holders for both the months, because when the 5 lakh unit holders came into picture, they also contributed for the January's income 0.40. Now we can say that 305 are the unit holders for both the months. So for both months income will be contributed or will be shared by 305 lakh units. So 60.40 is the total income now, which will be shared by 305 lakh units. See, 36 lakhs you are going to add to the previous income. The total income will become 60.40. The total balance was 305. That means at this point of time, every unit holder is earning 0.1980. Every unit's earning is 0.1980. Okay, good. Now what is happening is, on this day 2.5 lakh unit holders or units has been repurchased by the mutual fund. So obviously they are going to get paid for it. And the question says that this is not the NAV. Please make sure that The question says that the issue price or the repurchase price is opening NAV. It has specifically written that opening NAV has to be considered, minus 2% of the exit load, and see, this will go, no? This is an outflow. And or there will be dividend equalization. So they will get paid because they're going out of the mutual fund. They will get paid for whatever their share of income was at that point of time. See, out of this 305 lakh units, each unit has an income of 0.1980. So if 2.5 lakh units are going out of the picture, 0.1980 will be their dividend equalization reserve that will be paid to them. 0.1980. So 0.1980 will be an outflow. So you will, your 20.25 plus 0.1980, you are going to add that, and you are going to deduct this minus 0.405. The pre-purchase price will be 20.043. This is going as a cash outflow from the mutual fund. Let's have a look. 20.043. You can see this 0.198. For this is the 2 months income. And after that, the balance left is only 302.50 lakhs. The total income is this much because we have paid around 0.49 lakhs rupees of the income to the outgoing unit holders. So at this point of time, by 28th Feb, the closing balance is 302.5 lakhs. Every unit holder is earning 0.1980 and the total income is 59.90 in the balance reserve. This is 59.90, the total income. Now in the month of March, 47 lakh rupees is the earning. Who do you think, how many unit holders, how many units has the right on this 47 lakh units? I will tell you. This will be the 302.5. This much of the units will have the right on 47 lakhs. So when we started, 300 lakhs has the right on this much, 305 lakh units has the right on this much, and 302.5 lakh units will have the right on 47 lakhs. So this will give you per unit income. Now we were continuing with a balance income of 59.90. The additional income is 47. So you can say the total income of all the 3 months, the total income of 302.5 lakh units is this much, 106. You cannot just make a total of this. Please ensure that you cannot make a total of this thing. You cannot do that. Yeah, but what you can do is 0.08, 24 by 300 is 0.08. So if 5 lakhs is coming, 5 plus 0.40 you can add here, 5 into the additional units into 0.08, and there will be certain calculation that you have to do. So that the table is better one only. You cannot do the total of this. This is not the only income, na? These 3 figures are not the only income, because what is happening apart from these 3 income is that something is coming also in as dividend equalization reserve and going out as dividend equalization reserve, 0.495 or something, right? So you will have to make the adjustment for that also. And then the figure of 106.9050 will come. And that entire figure, see what happens. 302.5 lakh closing units. For these guys, the income available right now is 106.9050, and the question clearly says that 70% of the available income is distributed to the unit holders. So distribute 70% of 106.9050 to the unit holders. Automatically this income will get reduced, and this will be the balance available for distribution to these unit holders only, 302.50. Now if someone comes into the picture, if someone buys the units of the mutual fund, they will have to contribute 0.1060 as an income, because the balance income is already distributed to these unit holders. So the only thing that they will have to contribute is 0.1060 if someone is coming into the picture now. Getting it? This is how the dividend equalization works. Okay, so we have reached at this stage of, we have I think solved first, second and third part. First part 32.0715. The second and third part is also solved by us as the issue price and the repurchase price. So do you get the logic of issue price and the repurchase price? Issue price means you have to pay all these things. And how did we actually calculate the dividend equalization reserve? The moment you are coming into the picture, the previous income should also be contributed by you. See, the mutual fund has earned 0.08 rupees of income per unit. So if you are coming into the company, you first contribute that much of the income, right? So this is how we have done this. Now come to the closing value of net assets at the end of March. Now what is exactly happening? This is the income available for distribution. Still we have this much of the cash flow with us, 32.0715. But please ensure one thing, we have more than that with us, because we have issued 5 lakhs into, understand, 5 lakhs into this much of the this will be considered as an inflow. Do you get it? 5 lakhs into 20.735. And there will be an outflow also, 2.5 lakhs into 20.043. This is an outflow to the mutual fund. So this is an inflow, this is an outflow. What else? 3 months of income is an inflow. The distribution is an outflow. Okay, see, I will show you how to calculate that, because this is a tricky one. You need to understand the last calculation. We have to calculate the NAV at the end, right? And there are only two things: net assets calculation minus net assets is itself, and it includes only two things: investment and cash balance. So investment, let's talk about the investment. There was an opening investment. I told you the opening value was 6075, right? And there was an appreciation in that which made it 6535. So let's write down 6075 plus appreciation. How much is the appreciation in the entire 3 months period? The appreciation is 460 lakhs. Okay, so the total will be 6535. Now the major part is the cash flow. From the start to this point, include every cash flow. Include every cash flow. Inflow, add it; outflow, deduct it. That's it, simple. So let's go and look at this particular thing. The very first cash flow, I will just make sure that you are having a look at this. You started with this point. There was no cash flow at this point. The first cash flow happened at 31st January. There are two cash flows that happened at this particular time. We received an income of 24 lakhs. Am I right? Income of 24 lakhs. This is an income. We received that 24 lakhs. Apart from that, we also sold 5 lakh units at an issue price of 20.735. So this is also an inflow because we sold it. So 24 and 20.735. Have a look. Cash balance first. This is in January. 24 lakhs. I'm just writing it roughly. And then some units have been issued. 5 into 20.735. Am I right? Right. So this is also an inflow. 103.675. Now what happened in February? February there is an income of 36 lakhs. So income 36 lakhs. It will be added in the cash balance. But there was a repurchase at this point. How much? 2.5 lakhs into the reissue price or repurchase price, sorry. That's 20.043. So you paid this much out of your pockets. Your closing balance will go down. 2.5 into 20.043. So that's around 50.1075. This is the only thing that happened in the February. Then March. What was the income? In March, you earned around 47 lakh rupees. and you distributed some income. You remember that thing? In March, what happened is you distributed 70% of the income, and that is a cash outflow to you. The balance of 32 is not the cash flow. It is not an inflow and outflow. This is the cash outflow to you, 74.8335. 74.8335. So have a look. This is inflow, 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 outflow, inflow, outflow. Apart from that, you have taken all the 3 months income, you have issued, repurchased and distributed income also. Apart from that, do you think there is any other outflow or inflow in the question? Nothing. There is no other thing. You might ask one thing. I will tell you. You might have a doubt that, sir, this dividend equalization is also contributed by the 5 lakh unit holders now. So they contributed 0.40 lakhs in this point. You will just point out that figure. That why are you not considering this as a cash inflow? Why are you not considering this as a cash outflow? Because they are going out and you are paying dividend equalization to them. Why we are not considering this? I am telling you one thing. This has already been considered, because the moment you take this figure 20.735 and 20.043, see, 20.735 and 20.043, this figure is arrived after considering the dividend equalization. So if you are going with this figure, that means you have already considered all the three figures. So yes, sir, your point is right. 0.40 is a cash inflow, 0.495 is a cash outflow. We should consider that, but we have already considered it. Why to do the double treatment, duplicate it, right? So let's go and find out. There are 6 treatments in the cash balance. These 2 are related to the portfolio appreciation. These 2, right? And then issue of fresh units 1, income received 2, 3 and 4. Right? Income received. Then less units repurchased 5 and income distribution 6. So the total of all this, how much is that? Will be your 24 plus 103.675 plus 36 minus 50.1075 plus 47 minus 74.8335. So it should be around 85.735. Let me check. The total is given there, na? So I will just make sure 85.735. Now let me just write it here. And 6535. It comes to 6620.734. Let's check the final answer. 6620. Yeah, 6620.734. You have 6620.734 in this case. So this is going to be the closing net assets. The number of units that you were holding is 302.5 lakhs at the end of the month. And this is going to be the closing NAV. That's it. Simple enough. Ensuring that you are taking all the cash inflows and outflows will be a task. It is not going to be an easy thing. You might skip. You will take the income received. I am pretty much sure about it. But you might skip this income distributed. You might skip this issue wala thing, or you might skip this unit repurchase wala thing. So whatever might happen with you can happen with you. So this is how we can calculate the closing NAV, and I hope you are okay with the concept now with the dividend equalization. Dividend equalization is something which is introduced to make sure that the loophole is filled up or undue advantage is not taken by any kind of investors, and the investors who are waiting for so long should get their due benefit. So this is the entire question of the dividend equalization reserve. Let's focus on the last question of our mutual fund chapter. This is an easiest question. Have a look. So let's have a look on question number 40. And see, this is a question where institute will check the knowledge of your mutual fund. Institute has recently started asking such type of a question where the reverse calculation is required. And I'm very happy with this type of a question, because this question makes you like think a lot and will test you the knowledge of whatever you have learned till now. This is an easy question, but it's not easy for those who don't know the concept, who cannot apply their brains. Let's have a look. The asset management company on the mutual fund has declared a dividend of 9.98%. Okay. The dividend of 9.98% on the units under the dividend reinvestment plan. This is a reinvestment plan, means whatever the dividend has been declared, it will be reinvested back at a particular NAV for the year ended 31st March 2021. The investors are issued, see, they have declared the dividend at the end of the year. The investors are issued additional units for the dividend at the rate of closing NAV. It's very clear that they have received an additional units at a rate of closing NAV, and the closing NAV is given as 24.95. So this is the first or the second figure that they have given. An investor of Mr. X who is having 20,800 units at the end of the year. That means after receiving the additional units, the total was 20,800. It's not the before issuing the additional units. Okay. Made an investment in the units before the declaration of the dividend. That means he received the additional units, and after that, opening units plus additional units is equal to 20,800 at a rate, and at the rate of opening NAV plus entry load of 0.04. So he purchased some units. We don't know yet. Let's say it is X. So he purchased X units at an opening NAV. We don't know that one also. Opening NAV plus a entry load of 0.04. This NAV has appreciated by 25% during the year. You are required to calculate, assume the face value as 10. You are required to calculate the opening NAV, the number of units that he has purchased in the beginning. So this is NAV 0, this is N0, and the original amount of investment means NAV, not NAV, we can say the issue price or the public offer price into N0. So this is what you have to calculate. Now focus on this. It becomes very easy to understand a question when you draw a timeline. This is 1 year. He has the number of units here and NAV also. How many number of units? 20,800, and the NAV here is 24.95. Now the very first thing I will go with is the NAV. You can see the NAV has, question is saying something about the NAV. It has appreciated by 25%. It is very clear. The NAV has appreciated by 25% during the year. So if we reduce 25% from this, we will get the NAV 0. But don't do it directly 25%, because 100 plus 25 is, this is the 125% value. 24.95. So this is going to be the first answer to you. NAV 1 is equal to NAV 0 plus, or we can say multiplied by 1.25. Simple calculation. 100 and 25%. So 24.95 divided by 1.25 will be your NAV. So NAV 0 is nothing but 19.96. We will call it as opening NAV, the answer to the first part. That's easy. Okay. Second thing, they are saying the number of units purchased. Okay. Now, let's say the number of units that you purchased is X. Okay. This is one thing. How did you arrive at N1? 20,800. Closing units is equal to opening units that you purchased plus additional units that you have received from investing the dividend back. Let's say opening, this is 20,800. Opening units is X plus how many additional units you have received. Let's do the calculation. Let's do the calculation of the dividend first. Okay. You received the dividend and then you invested back at the NAV, closing NAV, to get that additional units. Okay, so X plus, let's find out the dividend amount. The dividend face value is 10 rupees. You received 9.98% on every unit. Okay, and the total number of units are X. So this entire figure will give you the total dividend divided by the closing NAV, which is 24.95. Am I right? Question clearly mentions that you have reinvested the dividend at this NAV. So you have the figures now. You have all the figures in the equation. You just have to calculate the value of X. When you multiply 24.95 in the numerator and transfer this 24.95 on the left hand side, the calculation will be 20,800 into 24.95, which becomes 5,18,960. And this becomes 24.95 plus 9.98% of 10 is nothing but 0.998. 0.998x, right? I'm not writing anything in the denominator because I have transferred that denominator on the left hand side. Now solve the equation. 5,18,960 divided by 25 point how much? 24.95 plus this is x. This is x, man. 0.998. That's 25.948. And this is going to be your x. Your x means the answer x, not x, that x. So it comes to 20,000. This is the second answer. The number of units that you purchased in the beginning. Now the original amount of investment. The third part. Investment is very simple. Issue price. We cannot take the NAV here because we have to add entry load in that. Issue price into number of units. So issue price is nothing but NAV 0 plus entry load into N0. And now 19.96 plus 0.04 into 20,000, 4 lakh rupees. Simple enough. So you have calculated all the three answers. 19.96, 20,000 is the total number of units, and 40,000, 4 lakh, sorry, 4 lakh is the total amount of investment. That's what is given in this question. See, 1.25 divided in this side, you have calculated this. See, 20,800 closing units, this is the opening units, and this is the additional units, and then X is 20,000. Initial NAV, entry load 20 rupees is the issue price, you can say, and number of units purchased, funds purchased, number of funds purchased, please correct this, units. With this, sir, we end the chapter of mutual fund. We have solved all the 40 questions with a great conceptual learning. In the next chapter, we are going to continue. Okay, this volume 1 is over. So we can say almost 40-45% of the syllabus is over. Then from the next lecture, we are going to start with the derivatives chapter, and it is going to be little technical chapter. So you will have to pay a lot more attention in that. But I will make sure that you understand the logics very much. Please make sure that before going back to the derivatives, before starting the derivatives, you ensure you read the time value of money logics, or we can say you just go through the time value of money formulas in the beginning, because these will be used a lot in the next chapter. Happy learning. Bye bye.